to the show, and it is a sunny and bright 18th of September. Chris is here looking quizzically at me because maybe it wasn't bright for him.
It wasn't bright when I came in this morning. It was grim. It's warm.
Marching. It is warm. It's muggy.
It's warm, 18 degrees, but it wasn't. I was surprised how dark it was. Sorry, I thought you'd come into a different city this morning.
Oh, well, I was coming in. It was relative.
Where did you get off? London Bridge?
Yes, London Bridge, but I march across that bridge.
Oh, at Moorgate, it was cloudy and stuff.
Oh, okay. I had a bit of a sunrise, and also I was thinking, this is so nice. This is so nice.
In earlier than you, so clearly.
Indian summer, hopefully.
Indian summer, yes.
Yes, but you're right. It was
one of 2 days, I think, isn't it? I think today and tomorrow. And that's
Is that it?
Yeah, I think so.
Oh,
and then back down again.
Morning, everyone. Donny1 saying good post FOMC, everyone. Shilling is also with us this morning, and a person loving that handle of yours. Gavin Ackers, good morning to you as well. And Wing It Maturin, hola. Steve CDR, morning to you as well. And Derek. Fed dot plots interesting last night. Perhaps a sign of things to come. So we're going to go and look at what's coming up on the show, and then we're going to ask Chris where he was during that speech last night. Here we are. Chris?
We have overnight action with you and me. This is going to be very similar. Oh, and then opening bell with you and me. It's exciting. But then it changes. We're going to shake it up a little bit with fast markets at 8:15, where Axel, our technical whiz, joins us to see what he thinks about last night's Fed decision from a technical perspective.
Yes, of course. None of that fundamental business. And then we will have Ron Williams with us on Expert Edge. Also a bit more technical analysis for those of you. So a lot of exciting stuff. He brings his own charts with him too, to give us a different view of what he is expecting, not wanting
very picky about bringing their own charts.
Yes, very picky. And also he's coming earlier to make sure the connections work, because I raved about our new studio. I'll take you through all sessions. Of course, a lot of those now part of the 24-hour offering.
Yes, very good.
IG. Yes, a lot of excitement surrounding that the last few weeks, because a lot of our clients liking the fact that they can trade any time of day. For those of you that don't like sleeping. And then we have man versus machine.
I'll be guesting for Aaron. Now, some might say which one's the man and which is the machine of me and Aaron, I suppose.
You're clearly the machine.
Clearly, I think that's I was going to say that anyway, so you got it. But yes, and then what looks like a late addition to the schedule, as we were talking, live, 9:35. You are joined by a legend, I think it's fair to say, of the city of London, Peter Hambrough. They don't come, the names Hambrough, they don't come bigger than that, do they really?
No, especially not in banking.
No.
And mining.
Yes, and I was reading a book about the Great Depression, and the Hambroughs crop up in there. So yes, it's a long, storied banking dynasty.
Yes, he's got lots of skeletons and lots of stories as well. Not to mention, one of our very astute viewers asked yesterday, does IG have any idea how big this person is and the person's net worth? And also someone else on our, I'm not making this up because they seem to have cottoned on to the fact when they email ask@ig.com, it all comes to me and I happen to reply. Asking, when is Peter coming back on again? Because they want an update on, that 5,000 target. He said this time next year, we could possibly be at 5,000 for gold.
Yeah, I don't disagree with that. That's not very cool.
Speaking of which, there was a synchronized. Where were you during the?
Where was I? Well, of course, you were out and I were out. So I was out as well. So
where were you?
I was at my old school speech day for some reason. I don't know why I got an invite. I wasn't the guest speaker. I don't know why I got an invite, just because I was a guest of the headmaster.
Oh, what did you do? What did you do?
I didn't do anything. I just turned up. We had drinkies in the boardroom.
No, what did you do to garner such favour?
I don't know. No, distinguished city personality. No, not really. And then we had speech day.
Nice.
It wasn't the most interesting speaker in the world about renewable, energy-efficient housing. He works in energy-efficient housing.
I see.
It was a bit about this, so he wasn't that fascinating. But it was just nice to go and see the old place again, even though I left some years ago.
Did everything look rather tiny, Get back. It's like everything looks
No, it wasn't primary school. It's not that. All the chairs really small.
yeah, but everything is
No, it has changed a lot since I left, so always nice to go back and see it.
brilliant. Well, I have a special treat for you because Chris
You were
was
asked-
invited.
Yes.
You were invited. You snubbed us.
Yes, I wasn't
Snubbed
didn't snub. I was
Axel
double
and
booked.
myself.
But Axel kindly invited me. Yeah.
Axel was
Where
in
were
true
you?
form. So I was at the STA presentation of the certificates to the new members of the Society of Technical Analysts. In layman's speak, that is those people that survived the 3-hour exam and came out to tell the tale.
Which you did, of course, and passed.
Well, barely. I think I had a flask. Thank you, Monkey Man, for telling me to make sure I had plenty of coffee. Thank you, Rich, as well, that reminded me. He reminded me. Make sure you have lots and lots and lots of food next to you because you are not going to be able to leave the desk. And true enough, I did not leave the desk. I used every single minute.
Isn't that the point of an exam? You're not allowed to leave the desk.
Well, some people finish early, or if you.
I hate people like that.
Yeah, but you can go. Either they failed or they
Yes.
know everything.
Or the people that ask for more paper all the time, and then you think, how much are they writing?
Yes. I'm in the carve out my eraser into a cube and hope for the best. But I couldn't for this level 2 because it was all written. None of it was
not
multiple
multiple choice.
No. And so last night was the presentation. There it is, a certificate. And there we are. Axel was on my right. He delivered a beautiful speech on my left, on the right of the picture. Thank you. I did not have a razzle last night. I have to say I left at 8 p.m. You can ask Axel because I had to be up, bright-eyed, bushy tail.
Or up at least, anyway.
This morning, and then there we are. I also caught a picture of Axel delivering his speech and welcoming all the new members.
In the august surroundings of the National Liberal Club, isn't it?
Yes, I have not been there before.
No, I haven't. No, I need to go.
It was absolutely stunning. Winston Churchill in the drawing room wouldn't have looked out of place.
No, but then of course he left the Liberals, so
Yes, he did leave the Liberals. I was waiting for you.
that's why he's in the cult and up the road.
Yes, and never to ever appear that side. But, you get the idea, right? Lots of old books, bookcases,
Yes.
leather, on desks.
Yes.
What else were?
Very august. Do you spot the Liberal politicians? There aren't many left these days.
Not many left
Davey,
these days. You're right. No, I didn't spot any politicians. I did cast my eye like a very good analyst into the other rooms. Axel might have thought I was just
Poking around.
yeah, I was actually going to change my shoes, but morning Pelican, good morning to you, and also Maturin saying Green Lane Renewables on the charge yesterday up 30%. I am indeed happy, except I took Wardy's advice, and also Axel and you talk a lot about this, about risk reward and understanding your risk.
Yeah.
I took out my capital and half my profits.
Right.
So that 30% isn't up as much as if I had left.
No.
But it was a punt. Cow poo is a punt.
You can say that again.
Right, let's go to overnight action. Right, let's have a look first at, the FOMC. What did you think of it?
What did
It
we
was a bit
get?
boring, wasn't it?
It was, and I managed to sit through it without, and I didn't get, none of my positions got stopped out, so I was quite pleased because I wasn't able to check it live. I think you were probably more able to check at 7 o'clock. But the 25 basis point cut probably leans slightly dovish, I think it has to be said. If you look at the dot plot, they're expecting a couple more cuts of 25 basis points this year. Obviously, Stephen Mirren, the outlier on the Fed board, hasn't managed to convince anybody. The new boy. Imagine being the new boy in that meeting.
I know.
Hi, I'm Stephen. I'm here for a short while to do as I'm told.
Yeah, I am. I'm that person.
Parachuted
in by the Orange Man.
Yeah.
And I've been hearing about puns over Stephen's surname, which I can't really mention the rest of them. This is from those in the circles that go to the presses.
Right.
So it rhymes with siren.
Right.
Myron.
Does it? I thought it was Mirren.
It rhymes with siren.
Okay.
And so no prizes for guessing what else it science rhymes with lots of yes, other things. Thank you, gallery. That's enough. But the interesting thing, the drama was actually more about what was happening behind the scenes. I mean, he didn't stand back and wait a bit. It was like I'm just going to go in and I'm going to do what I'm told, and he did actually waste no time at all with breaking with the majority, suggesting the steeper half-point cut.
Yeah, he did. But as John, author of the Blue Book, was saying, it was kind of the dog that didn't bark because nobody else really went with him. You could spot his dot plot right down the bottom. And it wasn't as if there was a sudden caucus of people agreeing with him and saying there should be more. So the worries about Fed independence have been allayed for the time being, I think, because everybody knows that Powell's going anywhere, there'll be a new person. So I don't think that the Fed board, and maybe they're feeling a bit safer this week now, obviously, since Cook has, the case against Cook seems to have fallen apart, which we'll come to maybe in a minute, because
be a fly on the wall.
The revelations of the fact that Besant used the same process means that they slightly lose their force, shall we say. And this, of course, is a carryover of the guy at the housing agency, Poult, who seems to have probably leaked this about Besant after their falling out a couple of weeks ago. Did you catch this?
Is this about the it became something akin to
a fist fight?
Yes, fist fight. And
harsh words were exchanged now.
And almost came to blows.
Yeah, now I think everybody's team Besant because he always seems to pick on people that nobody likes. Because first it was threatening to punch Musk, and now it's threatening to punch the head of the housing agency. In very fruity language, if you look it up at home, it was reported. We won't repeat it here, but it's a very entertaining story. They had to be sat apart, very far apart at the dinner. So anyway, so the point from this is that the Fed has leaned dovish. In fact, I've written about 4 things this morning, 2 of which say dovish, 2 of which say hawkish. I think that tells you what
you're offsetting yourself.
They've probably sort of hit the right note, I think, and the fact there's a lack of market reaction, I think, is generally good. I think the average reaction on Powell Fed days has been broadly negative. So the fact it held up okay, I think will please the Fed. So it's good overall, probably good for stocks into the medium term, probably less good for the dollar, let's put it that way. Doesn't really disrupt the overall narrative, although we've still got to watch. Inflation seems to be de-emphasised, so that the 2 halves of the mandate, I think the greater weight goes to employment, as you'd expect. And now we wait and see whether the data continues to support that view. Interestingly enough, you get jobless claims today, and they're supposed to be not as bad as last week, because last week's claims were sort of the worry that really showed you that maybe everything was getting weaker. Although I think it was down to some sort of fraud claims in Texas. So even that seems to have been slightly overdone. Anyway, this is where we are with the Fed. 2 more cuts expected by year end.
I mean, you're right. It shows a wide range of opinions about where the rate is headed. I just wish I was there when the first question, apparently, that was thrown at the press briefing, did you hear about this?
No.
Was, so what's with the new guy being a White House lackey, and how can the public trust the Fed is still independent?
That's brilliant. Who asked that?
I don't know. I'd love to find out. It was just like a message that, like, after I left yesterday, all these messages from mates from my past life going, damn, oh my goodness, have you seen this?
That's excellent.
Oh my goodness, yeah. And,
I'm going to look that up now.
Jay Powell, good on him, and looking like he genuinely believes that, the Fed is still going to be, independent, and he says strongly committed to maintaining our independence. But it must, in all things in politics, I'm sure you've covered this enough, your entire life, Chris. Optics matter.
Yes.
Optics do matter.
In fact, they probably matter more than the actual facts of the case.
Exactly. And they must know that this guy, Myron, rhymes with siren, is now teeing up or eyeing a job somewhere in the West Wing after, the Fed, perhaps, or somewhere down the line. So
he's not actually left his job at the White House, has he? Yet.
I don't think he has formally. So amid all that, let's have a look at the front page of CNBC. Looking like a slightly positive, and I've gone into the European markets a bit, looking like a positive open.
So I'm just reading the FT reporting last night. It says Stephen Mirren's dot plot looks like the kid on the playground the other children refuse to play with.
That's a good one. Yeah, so, you know, it'll be an interesting few months, let's put it that way. So after that, we're seeing that, you know, stocks look set to open higher, although not a huge amount higher. It looks like, you know, keep calm and carry on is the mood at the moment. Asia Pacific markets were mixed overnight. The Nikkei rising to a fresh record.
Yes, Japanese stocks on fire as well.
Dearie me, if I had known, I would have put all my money into the Nikkei.
Hindsight is the best trading fund in the world. But yes, stocks were very happy with it. There was a bit of sort of post-meeting wobble, as you'd expect, really, but they've shrugged that off. And so the Dow sitting, I mean, it was a new record high last night for the Dow as well, wasn't it? So very much delivering the goods for investors.
Delivering the goods indeed. And of course, Bank of England is going to announce its rate decision.
Yeah, but nobody cares.
No one cares about that. The main party.
It's supposed to hold rates. But the Bank of Canada cut rates yesterday as well, didn't they? So
No one cared.
Adds to the easing.
Yeah, at the STA, whilst we were waiting for the Axel, if you're listening, we were raptured. We were there watching every word.
You weren't definitely talking amongst yourselves.
We were there going bing, and you could see some people's iPhones vibrating, including mine, iPhones, Apple Watches, and everyone just leant over together, went, oh, 25, 25, and then we went back to listening again. So we were also one eye on the Fed. Speaking of that, what people do care about, or seemingly do care about, because I heard people talking about it on the tube today, is of course Trump on his second day today.
Yes, day 2 of the visit, yes.
You know, lots of the media here in the UK showing jolly pictures between Charlesy and the US president. Notably, not many of him and our politicians, at least not yet.
No, they're all kind of staying well out of shot, really, as you'd expect, really. He's off to Chequers today, isn't he? Off to the Prime Minister's country house. Not coming into central London, funnily enough.
Yes, strange that, because Axel and I didn't have to weave through quite a number of people who had placards.
Yes, did you?
Outside the National Gallery. So we were a bit worried that there were protests, but we were kind of thinking, he's not in London, is he? So yes, there's the banquet table, and Steve Schwarzman, the CEO of Blackstone, sat next to Starmer, and Tim Cook, Apple's Tim Cook, sat next to Tiffany Trump.
Oh, lucky old Tim Cook. What they chatted about for the entire evening.
Besant flanked the Queen. Or some, yes, the gallery are going to say certain things now, which I will not.
I think they probably said what I've just thought. Yes.
Yes, I also thought, but you know, Rupert Murdoch was there, as was Nvidia's Jensen Huang. He I would have liked to meet, and Sam Altman of OpenAI and Citigroup's Jane Fraser.
I wonder what the net worth of that table is then.
Probably
Don't say big.
Greater than the entire net worth of the Square Mile.
Well, yes.
Oh, are you going to use Perplexity?
No, I'm just going
Gemini.
to Google what the King's net worth is.
Andrew McKelvey coming on saying OM and Zen both raising cash. Bad news for shareholders like me. Look at you. Maturin also chiming in, talking about Halion downgraded by Barclays, but now at a strong level of support. Has it been punished too much? Are you still looking at the net worth?
No, I was looking at the net worth of the King, who's only 640 million, possibly modest compared to those around the table, really, which is a commentary on the state of the world, I suppose, but there we go.
Yeah. One thing that I found quite interesting, the Krispy Kreme rally, the meme. Did you see this?
I confess, no, I'm not up on my meme stocks.
So, yeah, meme stock watch here. This time, what I find most interesting is it's to do with the FBI director.
He looks like a man that really doesn't understand quite what he was getting himself in for, doesn't he? What is it? Who is he? Who is he? I don't know.
Kash Patel.
Yeah. Where's he come
is
from?
The director, FBI of the
Yeah, but
FBI.
where was he before?
I don't know where he was before, but you're right. He's got one of those like memorable type faces.
He looks like a man who doesn't spend his life in a suit most of the time and isn't very used to wearing one. I'm sorry, but it's just the way he looks. Surprised by everything that happens to him every day. I don't really understand. Yeah.
Yes, but what I find most interesting, other than how he is dressed as well, is that he was asked to testify before the House Judiciary Committee about his decision to buy individual stocks, including Krispy Kreme and ON Semiconductor. And the FBI director said he thought they were good buys. He said, before I got this job, I was trading stocks, but not a lot. Like most people, I follow certain industries. Well, stock traders were apparently listening to him because Krispy Kreme shares jumped as much as 11.5% after his comments. The rally was brief, and the shares ended the day higher by around 1%, erasing nearly all of the earlier gains.
Well, I mean, it's not been a great investment, has it? Because it was $20 back in 2021, and now it's $3. So he's not really the next Warren Buffett.
No, but what this illustrates is that there are a load of people out there just listening
Yes.
to people who clearly might not be that au fait in picking stocks and anything, but just listening to what they're saying, and then, they get this outsized move just because of something that was said in a test.
So Krispy Kreme's PR department will be sending him a large consignment.
With
to thank him for
thank you.
sugarcoating their results.
Yeah, thank you on the Krispy.
Yeah, exactly. Yes.
I love how you're always able to put a pun on.
Well, you've been doing this job long enough, you come up be able to do this kind of thing. Yes. The lowest form of, no, not the lowest form of wit, but one of the lowest forms of wit.
On that note, I'm going to give you some pictures of Krispy Kremes. I don't know about you guys. It's just way too sweet. I get a headache just eating
Yes,
half.
I think so. You can.
So, yeah. So, can we look at the stock? Or I take it Chris hasn't got his computer plugged in.
I thought I did, but my thing next to me has not. I'm just going to tap it because that might help.
The new studio has
Well, it's not my fault the gallery don't set me up properly, really. They plugged it in, but I'm not quite sure what happens after that, really.
Whilst I'm getting that up, I was going to ask
They'll
you.
hate me now.
Because there was an even split in the room last night, filled with lots of people from, Mitsuho, technical analysts from even Librem. Then there was people that I'd known for ages from Rathbones. And there was an even split people between whether or not quadruple witching is going to be something that will rock the markets this Friday, and the other half of the room saying, actually, I don't think it's going to. Which side of the camp do you sit on?
Oh, well, it's the kind of thing that you only really know after the fact, because there are some weeks when it does matter, other weeks, other months where it doesn't, I think is the key to understand that, really. This idea that it imparts a major direction in the market, most of the time it isn't, really, I think. If you're very, very short term, you might certainly see some volatility. If you're looking at the 5-minute charts, yes, you get a bit of volatility around it. But if you're looking at this long-term move, the potential is less, I think, for anything particularly big. I think the key thing to note is that you've had a Fed meeting, you've had a big rally, even since August. We're up sort of 2,000 points on the not quite 2,000 points on the Nasdaq 100, and so there is a lot of good news currently priced in. And that said,
It's priced to perfection. Is that what you're trying to say?
No, I wouldn't say. I don't like that phrase because that phrase has been trotted out repeatedly over the last year and it just keeps going up. I think it's more noting that we've come so far in a short space of time. You are in the window of sort of late September, early October weakness. So if it was going to kick off, now would be the time. It wouldn't be surprising that you get a Fed cutting rates and everyone says that's good for markets. There's the gallery laughing at me. I can tell,
Yes.
I can tell. This is why I've not got an earpiece, so I can't hear what they're screaming at me. Anyway, I think if you do get some weakness, it wouldn't be surprising to see it here, I think. So this is the key thing to watch in the short term.
The amount of green bars. This is the 15-minute chart, friends, but also taking a look at the daily as well, because take a look at that 1, 2, 3, 4, 5, 6, 7, 8, 9. I mean, you can see.
I think that's a record. I think that's a record for advances. To just go up and up and up.
Is it in the record?
I think so. Yes, I will need to check, but I think the data bods on social media were saying that yes, it's one of the strongest rallies for the Nasdaq, certainly in a very long time.
Yeah, and what's fascinating as well is if I go to the weekly chart, you can see a bit better here that just be aware that volume is petering off there. This is the weekly chart.
See, that's the thing that gets me. People say this about rallies, that you shouldn't trust a rally where the volume is declining. I think it doesn't really matter.
Oh, interesting. Tell us.
Because in rising markets, people tend to do less, I think, and you have people that mostly tend to hold on. So you tend to see the volume decline anyway. The volume then tends to rise as it becomes more volatile because people are doing more, perhaps selling more. So there's a lot of people who will say, oh, you have to be concerned about a rally that has volume declining. But the fact is about this rally since April that it's one of the most hated you've seen because everyone says it shouldn't keep going. Even when I came back from holiday in September, there were several people within minutes of me arriving in the office saying, oh, but it's time to drop a bit, isn't it, really? And look where we are. The Nasdaq has rallied 10 days in a row. Markets don't do what people want them to do, I think. And the fact that people still say, oh, it's due a pullback. Well, yes, it probably is on the law of averages, but that doesn't make it go down. We do need a catalyst. I can't tell you what that catalyst is. Maybe the catalyst is the Fed cutting rates, ironically, but it needs something. At the moment, that hasn't appeared, really. And the fact that the rally is broadening out with the Nikkei record highs, Chinese stocks at 4-year highs, shows you the strength in this bounce.
The only consistency here is markets tend to do what you don't want it to do.
Yeah.
It is great, teacher. I hear a poll there, so let us know. We'll have guess the chart first, but I'm going to type the poll out to you, Phil. Do you pull back or change your trading or investing portfolio when you see a drop in volume? We'd like to know. Right, we got guess the chart.
Mm-hmm. Well, where is it from?
UK. Where is it?
Oh, that narrows it down.
Phil, do we have a sector even? Oh,
well, don't narrow it down too much. That takes
okay,
the
so
fun out.
UK, here we go. What do you think the genre of music is going to be? Come on.
I'm waiting for something good. That's what I'm waiting for.
I quite like the hoedown. I quite like a country.
I've not heard the hoedown one.
Oh, there's a tango one as well. Right, here we go. Guess the chart.
The chart, she whispers. But does she tell the truth?
Step by step, I trace your line. A flicker red, a candle fine. You lead me up, you pull me down. You wear a bull's face, then turn around. Guess the chart, mi amor. Is it pain or is it profit I'm dancing for? With every tick I lose control. Your side raised glance devours my soul. Producer Phil plays coy. He shrugs while Rich is hedging all his plugs. But Ange, she sees, she knows the game. She whispered short, then lit the flame. A wick, a gap, a silent fall, a fib retracement, or none at all. The RSI is on the brink, but I can't move. I dare
Right, we're counting down to the opening bell. We'll announce the chart later. Lots of good guesses there. 3, 2, 1. Beat your head.
This is the bell.
This is the bell.
Right.
It was much louder. Thank you, whoever sent it to us from Nottingham. But it was starting to burst the eardrums of the gallery people.
Someone's
so that's why.
muffled it.
With gaffer tape. Speaking of which, it is. What is not muffled are the markets. We are
Oh, seamless transition. Very good.
riding higher there, and it's looking all blue at the moment, or green if you're using another platform there. But we are seeing Europe really coming off the mark pretty strong there. Well, Germany up 0.75%, FTSE up 0.25%. Let's have a look at the biggest movers here. FTSE first, winners. Chris, any of those jump out at you?
Well, it was some bereft of news apart from Next this morning. So I didn't see Next not in the top risers yet. But Relx, nearly 2% up. I haven't seen why. So I need to look up. I didn't see an upgrade for that. But Rolls-Royce, I can't say motoring ahead, can I? They're flying high. No, I can't because it's not the cars. But yes, moving high, 1.5%. Engine, same thing really. 3R Group at 1.3%. And then Whitbread, interestingly enough. So it's a few interesting names. Defence as well. BAE joining in. BP as well. And Barclays. All the Bs this morning. All the Bs moving higher.
All the Bs. Let's have a look at the losers list there. House Builders, Barrett Redrow down 0.75%. Centrica also down 1.2% there. Fresnillo down almost
having a bit of a knock because one of the best it was the best performer, the FTSE 100 this year, and it probably still is, given the way silver's performed. So not surprised to see it come off a little bit. But if you were missing out on the Fresnillo rally, maybe that's your chance to keep it on your watch list to buy the dip, perhaps. And then Sainsbury's off by 1% as well. So a little bit of a gloomier morning for UK stocks overall.
Yeah, let's have a look across to Germany, the Germans.
Are you required to do that? Because Rich does that as well.
No, I'm not required to do that. I'm saying it just because Infineon Technology. I had to think about something else to say because
I'll say it in German.
Well, when I was here, the producer Fred was here,
Yes.
and he didn't like anything pronounced in French.
No, I can imagine.
And then it just made Rich say more things in French.
Yes, I could also imagine that.
Just you saw my cheeky smile earlier. That was me saying no to Phil. Which caused a lot of consternation in the gallery. Infineon Technologies up 2% there. Siemens up 1% as well. Heidelberg Materials up more than 1%. Banks, Deutsche Bank.
Commerz and Deutsche. Commerzbank was Axel Rudolph's old shop. Of course, where he didn't join us from Commerzbank. Or did he? I think he did.
I think he did.
Yes, he did. Yes.
Yeah.
Long-standing employee of the company. Anyway, that's by the by.
Reinsurers also higher there. Munich Re. Let's take a look at the losers for you. Seeing Volkswagen down just 0.25% there. Henkel, another defensive, also down by 0.1%. Continental down 23%. What's going on there at Continental? Do you know?
Deflating, really. No, I need to look at that because interesting. The DAX overall is up nearly 0.8% in early trading, which is interesting because we hit a 4-month low this week. Down towards 23,300, seems to be recovering. So it's been a poor couple of months for the DAX. Although if you look at seasonality, as you know, I'm obsessed with seasonality. Actually, it's the best period for the DAX starts almost now. I think the 1st of October is usually the very strong performance for them. But next, still waiting for some data on Next.
Waiting to uncross. We'll keep an eye on that one for you. Phil, Terence and Cam, if you can keep an eye on that one because Next was very cautious on its second half trading outlook. Thanks so much, Phil. Also looking at France now. Let's go over to France. We've got Legrand at the top of the winners list, or Legrand. ST Micro 1.7% higher there. Chris?
Still a few defence names as well, Dussel in there coming up. And Thales, BNP as well. So better morning for banks. I imagine the charitable interpretation would be, I suppose, if the Fed is cutting rates, good for the US economy, good for everyone else, really. And of course, the French stocks absolutely stormy performance since the no confidence vote. So once again, in the annals of markets, political turmoil has proven to be a good moment for those looking for an entry point in markets, because there was all this bearishness about France and it was on the point of collapse. And of course, it doesn't happen. And then the market rallies. And very much the CAC having outperformed the DAX over the last couple of weeks, the French leaving the Germans far behind, which is an interesting turnaround, really.
It's also interesting to see that we've got quite a few industrial names much higher as well. Thales recovering some composure after overall they did have a good week in the DSEI, the Defence Summit last week. But prior to that, defence stocks have been paying. Nexus Open, I'm hearing down 5.5% there.
Ooh.
Let's have a look. 5.8% down. Look at that move.
But has it gone? Is it ex-div today?
Or is it because of the outlook? Have a look. Because it did say that it was cautious on its second half trading. Can I just say that next, I know that they stole the march when they came out with their, what is it, that book that everyone had? I seem to recall it. It's behind people's sofas at one point, wondering what on earth that thing was, and then seamlessly stealing the march and going online.
Well, yes.
But I often wonder, you know, how is Next able to keep going with the likes of ASOS? Is that how you say it?
Well, yes, but it's seen off ASOS entirely. ASOS is now the fallen angel, isn't it, really? And Next was a record high at 13 a share back in May. So just take a bit of a knock. Now, this is classic Next, of course, because every time they report, they say, in the guidance, it says, oh, the next 6 months, next year might not be quite so good. And the shares do drop often. And then the next report comes around, they say, oh, actually, we did really well and we did better than we thought. And then the shares rally. And they do this every time. Everyone seems to fall for it every time. And it works for them. And that's why the shares have done really, really well. But if you look at that, it's a classic example of long-term investing, because you had to hold Next all the way through from the highs of 2015 and just essentially not going anywhere. Now, there's a trading range for you, if ever there was one, of what, 6-7 years. So there's patience for you. You're still getting your dividend. You're still getting your long-term view. But obviously the shares themselves, where everything else is continuing to rally, are being left behind, probably because it's a UK stock. So even a quality company like Next just gets left out. And then suddenly, for whatever reason, it finally begins to break the upside and you get the breakout and it delivers to fresh record highs and indeed triples in the space of 2 years.
Absolutely. And also, if you didn't want to have that long-term hold, you could use technicals by having a line to draw where it's never ever a line, as you hear Axel say very often. It's an area of interest.
Yes, it's very, very wise.
Yes.
Because people draw lines and it gives you that false sense of security that it must hit that line. If it doesn't hit the line, it isn't relevant. No, I think it's an area of interest. Also, if you want to wind Axel up, start putting very thick lines on your charts, because that will annoy him considerably.
Do you do that on purpose?
No, but I do flag it when I see it and I send it to him, because I know it's better to sort of poke the bear a bit, because it's good to.
You love that, don't you?
It's good to wind up technical analysts.
We do, yeah. That's why Chris comes over every so often and drops
just to stir the pot.
Drops a T next to me. He knows it's quite easy with me. Drops a T or an F on purpose. But taking a look at this, if you wanted to look at this from a technical viewpoint and time your entry, you would look at a firm close above that area of interest that I've drawn for you. And also you could use your moving averages. I quite like this as well. So putting your moving average there. And can you see that it coincides? If you have a close above and consistently price action is above the area of interest, and it coincides with good volume, and also the fact that price action is happily above your moving averages.
Yes,
All three.
a good sign, of course. That's the kind of thing. The indicators, I think, should reinforce what the price is telling you anyway. They're not a substitute for the price itself. This is how I was always taught to view it.
Yeah, and I always look at what's supporting the data. I'm going to try and poke Axel here too, because numbers can lie, as we know.
Well, I suppose so, yes. And
They can.
If you want to view it, whenever someone asks me about a stock, someone says to me, what do you think of XYZ? I will always look at the chart first and say, is it going up? Is it going down? Is it going sideways? What's the market telling you about this stock? Which is why people, I think, find charts so useful, because you can get an at-a-glance view. Do people like this stock? Do people not like this stock? Okay, you do get stars that have periods of underperformance. The stocks haven't been recognised, but often, the reason why Nvidia goes up so much is because people like it because it's delivering the goods, and so you get a sense from the chart just by looking at it very quickly what the market's view on it is.
Just very quickly, we're going to go to good chart, but just pointing out that if you were looking for a bittersweet stock, you like chocolate?
We're good.
Barry Kobu shares down 4% after Deutsche Bank.
How is it pronounced?
Barry Kobu?
Okay, I didn't know. I wasn't trying to catch you out there.
I'm only repeating what I heard at a chocolate investing conference.
You go to all the fun places, don't you?
Thank you, Schroders.
But you didn't bring any chocolates back, I noticed.
This wasn't last night. This was a while ago when they were really pushing their commodities desk.
Okay.
So I learned a great deal about cocoa. and the CEO as well saying that the debt of the company has to come down. So if you like all that you've heard and the great moves that we're giving you, do hit the like and subscribe button, and also make sure that you don't just listen. We know that 50% of you there that are just listening. Don't do that, because it means that we can't bring you more of this good stuff. And guests, we've got Ron Williams coming up, and also Rich is having a well-deserved break because he's getting ready for the next Art of Investing podcast, which is being recorded today. Ashton 17, welcome to the show. Just join. Any views in Puma will be, and Adidas will be sorted later on. But first, let's have the winner of Guess the Chart.
Oh yeah, I forgot. What is it?
Ah.
Okay, not WH
didn't
Smith's, of
get
course. Smith's Group, not the same thing.
Julian has won. Well done, Julian. I was flummoxed.
I was flummoxed, actually.
Let's have a quick look here. Yeah, Smiths. Here we are. Very quickly, Smiths Group.
Engineering, of course. Okay.
And so, yeah, it's...
wow, they've done really well.
I like this chart. Very strong moves there recently, and also it obeys that upward momentum. It's left my moving averages on.
Yeah. I always say stuff that is going up tends to keep going up, and vice versa. I think
Don't try and fight it.
Nope.
Or guess,
Don't try and call turns. It's very dangerous. People love to do it. It's very dangerous.
And on that note, we've got Axel coming up.
It just sort of flows, doesn't it?
It flows. Ah, so wonderful. It seamless, like a Burberry trench coat.
Yes. Are they seamless? I've never
Which
had
I don't own, by the way. Own the shares, not the trench coat.
There you go. There's viewers can send in a Burberry trench coat. Yeah.
Right, and so hold on to your hats because we have Axel flying in soon.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat, come on. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hello everybody, welcome back to Fast Markets. Angeline has disappeared for coffee, so you are joined, I am joined, I should say, by Axel Rudolph, fresh from the celebrations at the STA do last night. Did you have a good time, Axel?
We did indeed, yes. Society of Technical Analysts annual do at the National Liberal Club. Always very nice to be there. And no, it's lovely. Plus, the weather wasn't actually as bad as I thought it was going to be, so we spent the rest of the evening on the terrace overlooking the Thames. So it was
very
lovely.
civilised.
So,
very civilised. Yeah. Super. So we have, what have we got this morning? What's moving this morning have we got? We've got Morgan Stanley cutting house builders. Maybe can we start with them? Do you think, should we do that? Barrett Redrow.
Let's do that, yeah.
Cut down from 560 to 510. Persimmon, Taylor Wimpey and Vistry all reduced. So if I just get them up on my screen in a second.
I mean, the problem with house builders in the UK has been that over the last few years, they haven't really done that well if you compare them to other FTSE 100 charts. And obviously, the reforms that Labour is trying to put in place in order to build more houses aren't happening at the speed probably the house builders would want them to happen. And that plus, in general, also still the backlog of supply disruptions that we had after COVID and things like that have negatively impact house builders. As you can see here on this Barrett's chart, I mean, it's not looking good, is it?
No, and this is what we were saying before the break about you can look at a chart and you can all see what the market thinks about it, can't you? And I think this is the market is sending you a message about Barrett, that you've had 2 years of rally for a broader stock market, and yet here we are with Barrett, that it's recently hit that low, is the lowest level since 2022. So another poor, very, very disappointing performance, isn't it, from Barrett, I think. What would you tell me about this chart, Axel? You're the expert.
Well, it's trying to bounce back, but the problem is it often looks as if it's trying to bounce back. If you go back to previous months, etc., where you were just now, you see these movements up, and then you see another leg down, movements up, and another leg down. So what we're seeing at the moment might just be one of those. Plus, if you look at the 400 area, just below there, we've got all these 3 lows going back to earlier this year, and then also last year. You've got a lot of resistance. So I'd be very surprised if Barrett Retro were to, even if it were to rise further, that share price, if it's going anywhere. If you want to read more about it, I wrote an article about the company, I think last week or this week. Just look at, or just go IG, Google it, IG, Barrett Retro, and you'll find it. So you can have a fundamental and a technical view on this share. But yes, house builders in general in the UK haven't done that well over the last few years.
Yeah, we had Barrett and Galliford Try reporting numbers on Tuesday, didn't we, I think?
Yes.
Not particularly well received, if you're looking at this chart. SIG Group is the next one, to throw a random name at you, actually, on the back of that. Angeline tells me it's moving.
Right.
I can find it. There we go. SIG.
Well, it's the same thing. It hasn't been done. It hasn't been doing very well, as you can see. A very, very clearly defined downtrend. Bad
performer, isn't it?
Yeah, and the problem is people when they buy stocks like this, basically they're trying to buy because they think it's cheap. Oh, it's going to go back up again. Well, it can go lower than you think, and it can keep on going lower than you think, and then you get these movements where it goes up a little bit, and you think, oh, it could actually go higher. So you don't want to get out of your stock, which has been underperforming. And you keep buying more, for example, and then it just goes down again. So that's not the right way, as we always say, Chris, to do things. It's better to buy something, even if it's making an all-time high, even if most people are scared to buy there, because the odds are that trend is going to continue and make new record highs. And with this stock, it's the opposite. It's more likely to hit its record lows and just continue to go down again. So next is a different story, though.
Yeah.
Next, as you've just mentioned, really interesting, because every time before earnings, their share price tends to go down, and then afterwards they beat expectations, goes back up, and as you said. And here we could see exactly the same thing happening. I mean, Next is in a very nice uptrend, and has been for quite a few months now.
Yeah, and this is the weekly chart, of course. I think it's a case of, and people talk about this. I don't know how much store you put by, Axel, but they're talking about the sort of distance you get between the price and a moving average. It's often a sort of sign of caution. I think it's sort of, if there's all this white space between one and the other, you often think, well, at some point that has to close. You often see that sort of distance or that gap close, don't you?
You do, yes, and technical analysts can use that as an indication of a stock market having moved too far away from the moving average and therefore likely to mean revert, which is happening here. But what is also interesting on this chart, if you see the spike high on the left, that's where our support is, just there exactly. So we are close on the weekly chart, so it's a pretty important support. So I wouldn't be surprised if we were to hold here in the next few days. The only worry I have is that the current weekly candle to the downside is obviously quite a long one, and that is not positive. It's not like the long candle we saw a few weeks ago beginning this big up move to the new highs. So we'll need to watch this one and to see whether that support's going to hold. It's not because it's a support that is there that it is going to hold. If you have a lot of momentum behind a down move, that support may be breached, in which case the next share price may go back to where it was sideways trading for several months previously this year. But it's interesting to see what's going to happen to the share price in the next few days. Obviously, today wasn't great. We've come off. But we've got this 200-day simple moving average here also coming in as support. So we'll see whether we can hold here or not, and then gradually build up again or not.
So we also had Puma was the request from in the chat, because there was speculation on Adidas picking up the stock as an acquisition. So there's another one. Oh, it's a bit of a similar story there in terms of a downtrend, isn't it?
Yeah, and that's probably why we've seen that spike high on the right-hand side of the chart. But as you see, we're still in very much bearish territory. Yeah, exactly. Wow. I mean, it's not done well, and a lot of people have kept their holdings of Puma, thinking, "Oh no, it's gonna come back, it's gonna come back," and every time it does go up a bit, it keeps going lower.
Well, you get
So,
these false dawns, don't you? You get this rally in early 23 that
exactly.
happened, and you think, oh, August 23, it's going to bounce. And repeatedly, what you think is the beginning of something is actually just the continuation of what we had before, really.
Yeah. And if you were a technical analyst, what you would have done here is just looked at that highs, and each of these bounces, even though they're quite significant at times, were lower than the previous one. So your trend was still intact. You still had a series of lower highs and lower lows. So there is actually no reason to go long.
Yeah.
But yeah, I mean, now obviously at this share price level, it might be a very interesting takeover target. And yes, Adidas may purchase the company.
Yeah, and lots like much cheaper than they could have got it. Nasdaq, of course, let's talk about last night's Fed-induced madness, where we had the brief drop for the index below 24,000, and then almost immediately, I mean, if we do the intraday chart, you can see that there, and then almost immediately back again, which you'd expect on Fed day, really, wouldn't you? I think the volatility is kind of a given.
Could you go onto a 5-minute chart, please, Chris? Because what's really interesting there is that I never trade around, these sort of announcements, because the volatilities, if you go further to left, I think it's just crazy. Can you see this bit there? Sort of up, down, up, and then sideways, does nothing, and then the trend gradually goes higher. But yes, I mean, you have to have such wide stops. You might just get stopped out at the high or at the low, and you might have even been right on your view, but gotten stopped out because of the volatility. So I would strongly suggest around those times of, BOE press conference, maybe less so, but ECB definitely press conference, the Fed even more, announcement and then press conference afterwards. Just wait, because when the trend establishes itself, you've got time to then slowly get into it, and it will just still perform, but you're not going to have this high volatility move that might just whipsaw you all the time before you actually get it right.
And then, of course, if you go out to a higher time frame, even the 4 hourlies, the move is minuscule by comparison, isn't it, really? And
exactly. And you already had a very nice trend in place. And if we go back to the daily chart, I mean, it's unbelievable. I know we both don't agree on what's happening next, and so far, Chris, you've definitely been right. I mean, this is just unbelievable.
I'll get that bit clipped out by the gallery. I think that would be good. It continues to rally.
Yeah, can you see all these green candles on the right hand side? If you just zoom into those, I mean, I don't know how many we've had now.
I think it was 10 as of yesterday, which I think we're saying is a record.
It is a record. It's crazy, but it is what it is. Markets that have a lot of momentum behind them keep going in that direction. In this case, it's up.
And the fact you had that brief dip and then immediately it gets seized on by weakness, I think, at least in the short term, sends you a message, doesn't it, really, that there's enough buying power behind this move to keep going in the short term, at least. Clearly, we don't know what happens next, but you've got, if you look at seasonality, roughly now is when it should come off, if September was any guide. Although September as a whole tends to be weak, and it hasn't. It was clearly outperformed your average September so far for the Nasdaq. And then obviously you get Q4 is very strong. So it's definitely one to watch, really, I think. And then we had a couple of requests as well, just to chuck these at you. D-Wave Quantum, I'm going to have to look this one up and hope I find it on the chart. Hang on.
Whilst you do that, I just want to mention that the Nasdaq is going higher. US markets in general making new record highs, but they might be doing it at the detriment of European markets. I mean, I know the DAX is back up again, but over the last few weeks, what we've seen, as you mentioned before, is the DAX and the CAC coming off, the CAC's then rallying after the political turmoil there. But basically, I think we continue to see a rotation out of European stocks back into US tech stocks. And that's also why yesterday the Nasdaq rallied quite strongly.
Yes, of course, was the comment from Bank of America earlier week. The fund manager survey came out and you showed the biggest drop in UK stock allocations month on month. So it's a limited view, but the biggest drop in allocation to UK equities for at least about, was it 15 years, I think it was. Having said that, you'd had the biggest move into UK stocks on a month-on-month basis in January. So these things tend to balance out. But it was interesting to note that maybe we are seeing, from being sort of out of the US in April and May, it's now reversed because obviously the tariff fear is reduced. You've got the Fed cutting rates it's enough to look at. So just one more to throw at you, D-Wave Quantum, a request there from the crew watching at home.
So I don't know anything about this stock, but all I can tell you is that the share price is looking pretty impressive because we've broken through these previous highs here, and we've just had this huge Marubozu pattern here, this big green candle on the right-hand side. And yeah, I mean, it just on the weekly chart looks extremely bullish. Can you go onto the monthly chart, please? I don't even know whether that's an all-time high or not.
I think it is.
But it looks like it.
Certainly as far as our data goes back, yeah.
Yeah. So strength, thank you, Chris, begins strength. I mean, this stock is rallying. I wouldn't get out of it for now because it can go quite a lot higher.
There you go. It's an interesting performance there. It must be something tech, surely, with a name like D-Wave Quantum. There's got to be something tech related in that, the way that's moving. Good. And I think that's all we have from that one. So thank you very much, everybody. We'll be back in a couple of minutes with I forgot what it is. Ron, William and Angeline will be back again. Thank you.
Thank you. Bye.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello, everyone. Welcome back And we have a special treat for you, a brand new guest, but one that is very familiar with the markets and widely known in the world of technical analysis. Ron Williams, welcome! Oh my goodness!
Great to be back.
He's also CFTE, and he was at the event last night.
Yes, I was at the STA annual gala event.
I left at 8. What time did you leave?
Shortly afterwards, after a busy work trip, I've decided to head back home and be ready for our session today.
Oh, fantastic. Well, I've primed everyone, told them that you were coming. So give us a quick introduction. Tell everyone, you know, your history, what you've done so far, what you're going to... He does a lot of travel, by the way, so it was very difficult to align our diaries.
All good and happy we could make it work. Basically, my focus is markets and mind, so it's a blend of the two. So markets in terms of market strategies, I've been doing that for 25 odd years, working with leading institutions, now run my own investment advisory research firm, and there's a consultancy part of that focuses on education training. The second part is, of course, the mindset, market and mind, and that's the realization that about 80% of what we do is all to do with subconscious behavioral patterns, and that in order to be successful at trading, we need to manage and raise awareness and then manage and optimize these patterns in a way that can be conducive to good trading. So I focus on both personally and with students and clients. And on the market analysis side, in brief, macro, tactical with a behavioral lens driven by cycles.
Nice. For those of you wanting to search for his work, just look up Ron Williams. And as a special favor to me, as I've known you for such a long time, I specifically asked Ron if you could bring in some of your special charts for us.
Yes, picture speaks 1,000 words. And I really think in charts, so hopefully that'll help with the visual engagement for the audience.
Nice. I like this one with the bull. Like, talk us through this.
Well, the headline theme is an emboldened bull still dancing on the edge. This is in terms of risk appetite that we saw first half of this year post shakeout. And credit to Hedgeye who drew the cartoon on a month-on-month basis. I look for these behavioral pictures that best capture the zeitgeist of the moment. It's a way of thinking laterally, having our biases in check, but then also understanding what the underlying themes might be. So this shows the bull is strong, yes, but it has been climbing a wall of worry, and it's been juggling live bombs during that process. So it is a face value positive sign of resilience, but at some point instability does show up, and you can see I've just labeled some of the live bombs: tariffs, geopolitics, and ultimately cycles. These are things that will continue to stay with us for a little bit longer.
Nice. So let's move on to the next page here, because I love it that you've got yellow for gold, because I use that for my lines in charting.
Very good. It's intuitive.
It is. It's very easy to spot when you've got slight astigmatism.
Yes.
Yeah, but I just use it across the board, not just gold, but other financial instruments too.
Well, a cultural point I do want to make. Red and green is not universal.
No, it's not.
Having lived in Asia and worked there for some years, I learned that pretty quickly. So red is good.
Yes, red is very good in Asia. And also some parts of Asia, like Japan, they have their red and greens in reverse.
Yes.
So red is actually up. You're having an up day if it's red, right? Greens are red, and green's not good.
So it's good to know that, I mean, based on the world audience that we're in, but also a personal choice depending on what stimulates your line of thinking when looking at these colors. Here, it's general colors, intuitive where possible in terms of gold, but you'll see light blue is Europe, shades of blue is so equities, I should say. Pink is treasuries, Asia is in shades of green. So there is some sense to at least regional geography and asset class. That's the general mix. But what we're looking at is trends over time in its purest, simplest form. Long-term, strategic, tactical, medium-term, and active short-term. For people that like to know the data that's driving this, think of annual, quarterly, and monthly as your general time durations for these trends. And the whole point of this is if the trends across these timeframes are consistently up or down, then it's a resilient trend and one that is best to back, either long or short. Here and now what we see is digital assets. Ethereum basically was leading, now potentially giving us an early unwind signal. Crypto acting as a risk-off potential, but Ethereum also outperforming Bitcoin for other reasons.
It
Equities.
has been for some time.
It has been for some time, and our main feature chart is of Ethereum as well. And look, switching from digital assets to equities, Japan and China outperforming the US, both at all-time highs. China's unwound a little bit, but with a very different valuation gap and various other factors that are making it more attractive at the moment. So that shows a little bit of global divergence taking place and rotation. Gold doing what gold has been doing for some time. The long-term trend remains strong, resumed higher, fueled by haven flows, but also resumption in inflation expectations with a broader commodity uptick. And that's the key thematic insight from this ranking model.
Nice. Talk us through duration, and you've labeled it strategic, tactical, and active. So talk us through duration.
Yes, so the key thing is to look for the outlier trends, up or down. But it's also important to look at rotation, and that is what we're seeing. Gold at the moment is in the strongest ranking trend, and it's consistent across the board. You can see it's a straight line across. Whereas Ethereum is strong on the left, which is the long-term annual trend, but has recently unwound, having broken above the 4K level. We'll see that shortly. And you can see it's outperformed Bitcoin. Bitcoin should be there further down lower. For those who can see the detail behind. Interestingly, USA, it's the market that we know so well and love in terms of price action liquidity. It's strong, but it is losing some momentum, and that is during this seasonality, typical volatile period of September and October. So a healthy unwind likely, especially for those markets that have moved the most and are overvalued.
Cool. So let's make this useful for, this is very useful, even more useful for our viewers. So let's say, we're looking at this and someone's in Ethereum, and we can see that it's on the strongest, right, on the left-hand side, but it's moved down to tactical, and then it's also moved down the list in Ethereum. What exactly should we take from this? Is it basically, in 50 in a quarter, in 3 months' time, perhaps you might want to reduce your holdings. In a year's time, if it moves further down and it moves into the active, but down towards neutral, should you then change it up so that you have even less exposure? I mean, how does it work?
So the best trends to back are the ones that are the strongest. And on this ranking model, it's strong or strongest. If you wanted to get an early signal, strong is your earliest, not before. We've backtested this many times over, including my mentor, Robin Griffiths, who originally designed the model 50 years ago.
Oh, wow.
And we've evolved it over time to include global, cross-asset. It works because it's simple and it's effective. And when we over-optimize, it works less effectively. But what we have realized is the best trends to back are once they emerge into strong and then strongest. The times to let go of those strong trends, because a trend remains your friend until signs of reversal emerge. I remind clients and students of that on a regular basis. That needs to confirm and follow through. But one of the signals on this model is a rotation out of strongest into weakest. So we typically look at the outliers, strongest and weakest, to see where the best and worst trends are currently, but also where they may progress. Now, your great question as to strategy and tactical really depends on who is in the market, if it's a long-term strategic investor versus a short-term tactical trader, based on their objectives, their strategies, risk, money management, and all the rest of it. But the best way to visually explain that point is the chart on the top right, which gives you an idea of the ripple effect. And you can see the big blue line giving you that long tidal wave move. But along the way, you get zigzags that take place throughout the market. How investors and traders take advantage of that ripple effect is down to their strategy and down to their objective at the time. So a tactical will look for short-term, swing opportunities up or down, depending if they want to take a long or short bias. And a long-term will buy and hold. Gold is a great example of buy and hold and buy on the dip. Ethereum, buy and hold because it's just been so strong and reflects the altcoin rotation. But perhaps lighten up now or wait to load up some more if it were to break up higher.
I'm interested, very interested in this wave because, what does your trend cycle model tell us about tech stocks? We have a huge number of clients that have positions in tech stocks. Of course, we've seen all indices in the US, keep climbing and climbing, despite almost ignoring any of the warning signals from the bond markets. And everyone's wondering, have tech stocks got too high, too soon, too fast? And where is this summer correction? So do you have any insight using this trend cycle model to do with tech specifically?
Happy to revert back to the question on the chart on the S&P 500, because that gives more hard and fast tangible signals as to what to expect next. Also, I say that given that the market has surprised so many times to the upside, so it is best to wait for real confirmation of momentum exhaustion, reversal and follow through. Otherwise, as is often the case, we're waiting for something to happen which hasn't happened yet. And then, of course, the market catches us out. So with tech in particular, the story has been phenomenal for the long term in terms of innovation, in terms of valuation. But momentum has been strong and yet continued. Concentration risk has been super strong at record highs and yet continued. So it's one of those runaway train trades, which is great when you're long and making money, but requires caution when we're calling an unwind.
That's brilliant. That's why we've got these wonderful charts coming up. So this, effectively, I like to call this like a heads-up display. Talk us through the charts here. I love that you've used perforated lines as well, because I do use that in bright yellow, because it kind of gives me a heads-up display as to where the next resistance points are.
Yes, and with dealing with crypto, big round numbers, but also a lot of volatility, 20% average per day. Ethereum has just really shot up in general as an alt digital asset leader, but also reversed Bitcoin's cross-crypto performance. And you can see the Ethereum on the main chart left. Breaking above 4K and now range bound between the next glass ceiling of 5K, but still holding 4. The averages are there just to give trend analysis, but also trend support. So you can see the 50-day quarterly average, as we were looking at in the model, is reflected on the chart. So we can see it in action. That is support at 4,288. And the long-term 200-day annual average is at 2830, a long way from where we are at the moment. But the 4K mark is support. The chart on the right shows Ethereum versus Bitcoin. So again, the big story is not just Ethereum shooting to the moon. It's Ethereum's relative outperformance across the board, especially Bitcoin. And we can see the reversal there of Bitcoin's kind of poster child outperformance.
Do we know how long this outperformance will last?
For a while longer, according to our analysis at RWA, based on just the trend analysis itself, but also Ethereum's story is partly built on the stablecoin enhancement of this year, which received more government support. Ethereum's the actually technology that is used for that. So there's some fundamental drivers which will likely make Ethereum stronger ahead.
There's a lot of mood music surrounding regulatory breakthrough in that space, where soon governments might allow crypto to be, put in wrappers, if you like ISAs and things like that. You positive? You feeling positive about this becoming a reality, or are you still skeptical?
Positive. Institutional flow is strong and hitting extremes, including Ethereum, and on the back of regulatory breakthroughs that you mentioned, and ultimately government support, specifically in the US as a case example, stablecoin and Ethereum benefiting from the technology side. It also allows more economic adoption, which maybe curtails a little bit of the rife speculation, which I think has been some of the concern since crypto's inception. We've moved on since then, but clearly it's going to be a relative game in terms of which cryptos win out and fulfill the needs of the market, and that'll be what most digital asset followers will continue to track.
Great. We have a question from Andrew McKelvey, which we can get to in a bit. Can Ron talk about gold, please?
Yes.
I know you got S&P first. S&P, let's have a quick look.
Yeah, S&P strong, but losing signs emerging of a loss of upside momentum. Remember, this is a market that rose from the ashes of the spring shakeout of earlier this year. Most people are in amnesia state. We've forgotten that there was a shakeout, 10% in a day or two.
How soon we forget? I did not forget.
Well, ultimately, we're governed by greed and fear, and when greed takes over, our eyes focus on that. And ultimately, the trend did recover back to all-time highs. But I think more than that, it's not just a surface value market recovery, it's the fact that we recovered so quickly, but also despite so many different uncertainties, headline spinners in terms of what next. And this wall of worry really came into fruition this year. If ever there was a climbing of the wall of worry, Wall Street acronym playing out, it was 2025 first half. The issue now is that we think that the market climbs that wall of worry forever. And the answer is, lines don't move up in a straight line forever.
Yeah, trees don't grow into the sky.
Right, and walls of worries typically resolve in a slope of hope. Is the complete acronym as created by Wall Street way back when, and all that means is there's asymmetric risk in the system, and that's what creates a market cycle. And look out for a healthy correction, if not a bigger shakeout, as we saw in March, but likely more prolonged. And according to our work, that matters in conjunction with complacency levels. So the top right-hand chart shows VIX, 2022 low extremes. Not a big record, but think back to what happened in 22. There were big negative surprises in the year. Buy and hold, 60-40 didn't work as well. And it became a trader's market with a lot of big swings. So that may echo again. And just lastly, in terms of the cycle overlays that we use at RWA, this is developed by the Foundation for the Study of Cycles. You can see there it's projecting time rhythms in future, and it suggests a seasonal dip into September and volatility to at least resume in some way.
I love this. This is why I love having Ron on, because he's very specific and he draws them out very clearly. Let's have a look at some of the other charts you've got here, because here we are, as if we knew that Andrew McKelvey was going to ask about gold. I also was going to ask you about gold because I have a position. Gold outperformance, what is next? I won't tell you what Peter Hambro said just yet, but I'll tell you at the end just to see whether it aligns with what you are saying. I haven't told him about my Peter Hambro interview. Right, let's talk about this climb, and you've got these new targets here.
Yeah, it's basically $4,000 glass ceiling next. Well, it could happen within the next few weeks. Gold has already broken out of its 6-month recent range and is moving quickly. Also, the bigger the range, the bigger the breakout. This chart shows the base formation that was a multi-year long-term formation, and the thinking there is the bigger the base, the higher in space. And we've seen most of that spacious high altitude move in gold already. We hit the original target, which I set at 3,400, and a 3x move from where we were years ago is into 4,000. So that's just, I decided to include the long-term chart there so that everyone could see gold's progression over time and just how impressive it's been. But also behind the scenes in terms of the technical projections and how we can work out the likelihood, probability of gold's current next move. In terms of why, clearly it's a strong trend, so it's a self-fulfilling positive strategy in terms of backing those strong trends, but also it's a warning signal. And I've been saying this to a lot of clients and colleagues in general, gold is storming higher for a reason. It is telling us that there is something happening that is not obvious in the risk-on phase. And part of that explanation, I think, is seen by safe haven flows that are extreme based in terms of macro uncertainty, both economic and geopolitical, which remain. They may ebb and flow. That seems to be the new risk-free rate now.
Yeah, it's the constant, the new normal, people.
It really is. And I think we're adapting to that, which is why we're still resiliently bullish. But we must still remember that there is a shaky ground that we're resiliently bullish on. And I think the other point, which has been evident for some time, demand from central bank institutions remains strong. And for the first time in 30 years, there is a crossover signal in central bank demand for gold over US Treasuries, and that's the chart on the top right. This is doing the rounds based on Bloomberg data, and it sends out the obvious point that the powers that be are looking to diversify, maybe for fiat currency reasons, but also this is out of Treasuries. Safety is taking a new guise. Gold is now taking front and center choice over Treasuries.
Yes, and I often wonder whether the climb in gold might have been higher had we not had Bitcoin and digital currencies. It might have taken some of that, shine off gold, because that is now also being seen as a place a home for liquidity, as a safe haven away from fiat currencies.
Yes, absolutely. I mean, it's a double positive for both gold and crypto, and Bitcoin in particular, and perhaps now Ethereum. The best guidance is to own both, based on work by an industry colleague, Charlie Morris. He's developed an ETF index that allows for that. We can do it plain vanilla or do an ETF.
Charlie Morris is in Bytree.
Yes.
I know Charlie.
And I think it's a volatility adjusted index, but essentially I think it averages out 80-20, 80% holding in gold, 20% in crypto. So for those who are more traditional finance, macro investors or traders, you can just do that. Don't have to choose between the two, just own both. But the benefit is, if they're both going up as they are now, partly for safe haven reasons, but also fiat currency hedge and inflation risks, based on expectations, you win twice. But that's not the main reason. The main reason why you own both is if volatility kicks in, you have a cushion. Gold provides a cushion on the high vol that crypto typically displays.
Nice. We've got another question from the floor. Please ask Ron if he thinks it'll be similar for the Russell 3000. What do you want? You want to do Russell first? Or I know you've got this fancy appendix.
They're the key charts. Happy to work on the questions that we have. But to circle back to the original question, I think, which was on NASDAQ, the S&P 500 chart, if we quickly go back to that, paints part of that picture because, as everyone likely knows, a big part of market cap in S&P 500 is tech. So where this moves, tech will likely follow. And the key level there is at 64 400 last time I updated this chart, which is the 50-day average. But basically a reversal from that compression pattern, if it breaks up, a little bit upside, but if it breaks down, that's your downside flush out signal at the very least into 6,000. And that would be tech-led because tech is still hot. Momentum is still strong to exhausted. And we're seeing some fast rotation in terms of liquidity flows, both institutional and retail. Which suggests that there could be a pump and dump signal in the short term. Doesn't mean that tech goes away. It remains strong in the medium to long term, but it has a healthy unwind.
Gotcha. Right. Russell?
Russell's the weakest link. I mean, in the Wall Street, Main Street comparison. And that's, if you have a live chart, we can look at it.
I'm going to get that up now.
But essentially, just look at Russell as a benchmark for Main Street, and also some of the small to medium cap stocks which have weaker fundamentals.
It's had a really good run.
It has not as much, but good run. An early signal beneath that trend line would be one to watch. If it holds, then that run will continue to support stronger breadth in the market, which is the lifeblood of a healthy market. But if you're looking to at least develop a defense strategy, it's good to watch how some of these trend structures hold or break down.
It's also been cited by many clients, because after the show I go and sit on the trading desk, and so it's really good. And also I use the Bloomberg over there, and as I'm using the Bloomberg, I can hear what's going on, you know, when our clients call up, and I hear the conversations between them and the client managers. There is a lot of music around, you know, whether Russell's a good place as a hedge. You know, should there be a froth taken off the market? What are your views on that?
Traditionally, yes, value outperforms growth as a rotational play, but there are exceptions. For example, when we're late cycle, because typically, if volatility is strong, then it's a one size fits all, and that tends to trickle through across the board. But the opportunity is to play it tactically. So I would say, yes, value could outperform, but do be careful with risk-reward trades. Manage it as astutely as possible, just because if there are fast reversals from those setups, it's best not to get caught out. The other thing is you could also look at sectors as a potential way of gauging not just growth value but actual sector play, which can be expressed through ETFs. And that
Which ones do you like as a hedge? I mean, the defensives. Some others I've spoken to have said they've gone into sin stocks. Which ones in particular?
Well, healthcare is unwinding. Utilities is a little bit of a hybrid defense because it has an AI element to it. But certainly it's something we should track. Some of the old patterns in terms of how defense used to play is changing now. So it's something to look at for those who are willing to play sectors.
Well, speaking of, talking about utilities, it piqued my interest when you said that is being skewed by AI, because it certainly is, especially for stocks like Oklo. Just showing you Oklo here, because that is pegged to energy related, to tech and AI. We've just got a few minutes left, but we've got through so much. Any other nuggets that you want to leave our viewers with before we head off to all sessions? Any other charts that have, kept you awake at night? You're about to go on this big trip. He's always traveling. I love the
Keeps you
cycles.
busy.
Yeah, it keeps you busy. Where
Also,
are you off
get
to
to see the markets through the eyes of people around the world.
I'm meant to be in Asia doing the same thing in a couple of weeks' time.
Wonderful.
So I'll be test driving lots of EVs there as well. I've been told by many colleagues who are awaiting my arrival that it's not the same as you were last year, and Chinese EVs everywhere. Plenty more for you to check out.
It is, and I was there last year for the IFTA annual conference, and that's exactly what we saw. As we were pulling up to the conference, we just saw a whole area dedicated to EVs, and it was what we read on newspaper headlines, but right in front of our eyes, and you'll see it for yourself too, I'm sure.
So yes, any other charts that that you have seen recently that?
Yeah, so we've covered cross-asset with exception to currencies, and I think it's worth looking at the dollar index.
Okay.
And then community members can draw what they may in terms of trades. Clearly, euro dollar will be an obvious derivation. But just to make the point, objectively and apolitically, because there might be Americans listening in.
We do actually. Yeah, Boston
I'm sure.
Frank.
There we go. And I was just in New York this past summer sharing the global view with the dollar chart, making the point that the dollar remains strong in terms of its reserve currency status, but the trend has weakened after a multi-year topping pattern, which broke down formally this year. And that's why we had a 10 to 11% depreciation in the dollar index, which most headline news was saying was the weakest drop in decades. That may be true, and clearly is significant for that reason, but also technically we could see further weakness in the dollar as expressed in the dollar index, and we're seeing this across the board. I mean, this is an expression of more currency majors, so euro, dollar, Japanese yen, pound, we're already seeing some of that. But also, if you look at other indices, perhaps on the Bloomberg terminal, you'll see emerging markets, big trend reversal against the dollar. There's also a commodity story there. If dollar weakens, commodities typically become cheaper. And
so I've got a theory. I'd love for you to poke holes in my theory, because it's based on that. So I think because of the weaker dollar, I love how you say weakening and all that. When I speak to analysts and strategists in the US, they go, it's being trashed. Is their technical term.
British diplomacy at its best.
The French language of love, British the language of diplomacy. So I think copper, for example, maybe next year is a year for copper, given we might see all the tariff issues start to not ebb away, but come to some form of compromise. There is still a huge case for copper, given all the tech and the AI that needs to be built, and the EVs as well. People forget that we do need copper in that area as well. And with the weak dollar, surely this would give its wind in its sails.
Yes, absolutely. So we're super bullish gold.
You can say that's totally rubbish.
Agreed on the commodity story. I'm reluctant to say copper here and now, just because it's been volatile. We had a pop to the upside and then a short-term shakeout following Trump's direct tariff on copper, which created an anomaly event. Copper remains a long-term strategic opportunity, both based on copper fundamentals. You mentioned the EV story as certainly being part of that, but there's an open question as to the pathway between here and then. So the best thing that I would recommend is for people to look at the commodity equity ratio, because that shows a generational rotation ahead, but it hasn't triggered yet. But if you look at commodities year to date, equal weighted, it's double digit. So commodities are an asset class that should really be better recognized. Weighting should be increased, and your IG audience, if they're not trading it, should at least take a look at it. And here and now, I think you just expect rotations. You're going to get early leadership. Precious metals, case in point. A lot of people say precious metals, gold, it's not a commodity, it's an asset. But ultimately, if your aim is to make money, then own it.
Yes, yes.
But also, you've got the double benefit of risk diversification, capital preservation, fiat currency, hedge. Copper's another one. Just study the fundamentals a little bit more and track the political tensions of the summer with the Iran strike and the 12-day war, geopolitics would likely stay with us for a while longer. And if so, that is a future event risk. Plus, oil generally is oversold, undervalued, looking technically like it's going to pop to the upside.
I am going to slightly disagree with that, because I think until OPEC Plus members say anything concrete about tightening, I think we're now in this new normal where the market almost ignores some of the geopolitical risk, because we saw after the strikes, gold essentially moved higher and then came back down. And then the second strike, if I'm not mistaken, my memory's not too great because I was at the STA last night. I did come back earlier. You can ask him. But we had oil go down, so WTI actually weakened. And we saw last week I was at the defense show at the DSEI here in London, also known as the all the BAE systems, Thales. Everyone's there, right? We had the drones earlier in the week, which broke Article 5 was breached, but nothing happened. There's no mood music on the ground there at all. Everyone's just, this just means there'll just be more talks. Carry on. So we're running out of time, but any questions for Ron, please slam the like and subscribe button, because it means that we can then bring him on a bit more and drag him from that aeroplane and maybe try and get him to reorganize his hefty business travel schedule. Get me here. Thank you so much for coming here in between trips for us, Ron.
Pleasure. Thanks for the invite.
Yeah.
And great to engage with with yourself and the new format. And a big thank you to everyone who's with us and has been asking some questions.
Fantastic. We've got Vape King also, and Kate Murphy. Kate Murphy is a client of ours, very a keen client of Rolls-Royce as well. We're going to wrap up, but yes, any questions, put it at ask@ig.com. I'll put it to
If I can quickly spotlight the point about lower dollar perhaps makes it easier to pay debt. Trump has said that himself.
He has.
So it is potentially policy-driven as too.
And there you have it. Stay with us, because we got Man versus Machine coming up next with Erin and Chris Beecham.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I'm but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Good morning and welcome back to Trade Live with IG. Welcome back to Man vs Machine. I'm Aaron Bright and I'm joined once again by Chris Beecham, Chief Market Analyst.
Becoming a regular occurrence.
It is. How are you doing, Chris?
Very well, thank you. Yeah, not too
Good. Yes. So for those of you who aren't aware of the segment, I know that we've got lots of fans out here already, but for those of you who aren't aware, myself and Martin Harris are portfolio managers at IG, and we are essentially up against ChatGPT to see if we can beat a chatbot at investing when it's constructed a portfolio. So to run through some of the ground rules for you, for those of you who don't know already, we're at episode 9 now. We asked ChatGPT to build a very comprehensive rundown of market conditions for investors. We then every week asked it, based on this analysis, do you recommend any changes to this investment portfolio for a long-term UK investor? We do obviously have some portfolio constraints. So long only, no leverage, max 50% in one ETF, 20% in one stock, and we want it to consider realistic UK behaviour as much as possible. So without further ado, let's talk through what AI has got built in its portfolio. Chris, anything that stands out to you particularly on here? I'm going to throw you under the bus here.
Well, you do it so well. It's the chunky defense. I must have said this last time, but the chunky defense allocation is always interesting.
It is, yeah.
I mean, the physical gold one. Is there enough in physical gold at the moment, given where it's going?
I'm bullish towards gold. I think you are as well, from when we spoke last time, a little bit bullish.
I don't like gold, but I think you can't argue with the price.
Exactly, right? So I think, you know, from a sort of valuation perspective, there's no way to sort of say, well, it's underpriced or overpriced, because there's no cash flows. But the dynamics for it are looking quite positive, especially if you see rate cuts come to fruition. And
exactly. I think you would probably rather hold a gold miner ETF than gold itself.
Well, yes and no. I've had experience holding gold miners, and it can be quite distressing if the dynamic goes the other way, because it is essentially geared gold.
Yeah, exactly.
So sometimes good, sometimes bad. So I think in this sort of scenario where we've seen gold prices, you know, shoot through the roof, gold miners definitely is more sort of leveraged exposure. But I think what stands out to me is, as you said, these chunky defense positions, you know, 18% in two defense stocks, which is quite chunky, quite impressive.
It is really. Yeah. I mean, it's not wrong at the moment, but certainly not in BAE. But I think it's a hefty commitment.
I would say that this is probably not the most traditional of portfolios. It's got a good diversified exposure, but probably not the most traditional. But if you compare that to ours, fairly traditional, I should say. You know, lots of different geographical exposures there that you can see. We decided to sort of do passive geographical exposure to get our equity positioning. We've done a little bit of thematic in Chinese internet exposure.
Yes, that's the excitement. I think there's your sort of
our punchy. Yeah. So it's not the most correlated to emerging to developed market stocks the whole time, and defense is you know a theme that we didn't want the idiosyncrasy of owning single stocks. So we decided to go for an ETF, which I think is sensible.
I think it's sensible in that case.
In certain scenarios, and then a little bit of oil exposure, and then still a chunky cash position. So I was having a conversation with Martin this week, holding for now, but we
haven't wrestled him down on that one yet.
No, so we're It's difficult to justify, though, at these valuations, sort of deploying cash. So that's
you
the
might
other argument.
certainly after the run you've had. I think
Yeah.
the problem is, of course, everyone's waiting for that pullback that stubbornly refuses
Exactly.
to arrive.
So then it becomes a case of performance chasing and just sort of fundamentals going out the window slightly.
You've got to get that year-end performance embellishment going.
Talking about performance, let's run through it. So, year to date, or performance to date, I should say, from the end of July, 3.5% AI, we're 3.2%, both above the index, pretty neck and neck. I mean, we are underperforming AI slightly, but only slightly, only 30 basis points. So nothing to write home too much about there. And in terms of the last week, 0.6% up, AI 1% up, and yeah, both ahead of the benchmark there.
Not a bad performance in a week.
No.
A very good September for markets generally, particularly in the US.
Yeah, you sent an interesting graphic to me the other day about how September usually is in markets.
It's usually down, and so far it's stubbornly out.
Yeah, it's almost like a 45-degree angle.
Yeah,
one of those
it's
like
complete inverse of what you normally get in September.
So it's been pretty straightforward. Because it's usually sort of with September. I mean, the past few years we've seen obviously. The various meetings with central banks, Jackson Hole, towards the end of August, and that sort of seeps into September volatility. Would you say that?
Yes, it does, and it gets these reputations with sort of 2008, and people remember those Septembers particularly of how bad they are. So there are a couple of shocking outliers.
Yeah.
That's what really drags September down. But on average, I think the last 10 days of September are the worst period of the year at all. So we're still to get through that as we speak. So that will be interesting.
Absolutely. But I think more importantly, how did things do throughout the week? So very, very clear to see where AI's performance came from. It's outperformance, should I say. I mean, BAE Systems up in that week, 9%. I mean, very impressive.
Which, of course, is the joy of a single stock position. When it does well, it does well.
Exactly. So this is what we were sort of saying before about idiosyncrasy. And if you compare that to the VanEck, I mean, obviously it picked up some of that performance, but it's never going to when you've got 50 plus stocks in an ETF at a couple of percent each at most. You're never ever going to get that strong returns unless literally the whole market is posting 8-9%, which is extremely rare, I would say. And yeah, BAE Systems had an interesting one. Obviously, there's been escalations a little bit with Israel and Hamas with the strikes in Qatar on the leadership there. We've seen as well, Russia and Ukraine, more tensions arise there, and we've seen BAE Systems being a potential beneficiary of the Ukraine-Russia conflict.
Yes, and talk about water deliveries to key partners like I think delivering vehicles to Sweden and Germany. You've got new shipbuilding orders coming through as well.
And Poland also being
one of the big defence spenders in Europe.
They're really on that sort of NATO border, would you say?
Yes, and they're already at the 5%, or they want to get to the 5% goal for NATO by next year.
Definitely,
that's a lot. So
I agree with that. And I think performance elsewhere. I mean, we're talking about idiosyncrasy a fair bit today, but look at next year energy. I mean, that's down almost 3%. So. It can go for you and it can go against you with these single stock positions. So.
I think obviously if you took out BAE, the AI's not had as good a week as you have.
No,
actually, if you sort of pick and choose a little bit, but yours is probably a broader base set of gains than it is the AI. And of course, your Nasdaq 100, that's arguably poised to run further. You've got Dan Ives, of course, noted tech bull saying the index could rally another 10% to year end. So that's one you'd expect to go further. Really.
Yeah. Absolutely.
Yeah, just sort of put your cash to work there. Put it all in there.
Maybe we'll have to recruit you on board to make some of these investments.
I think I'm too risque for Martin's approach to these things.
I think we have a question, though, for the AI.
Yes, we do. After this week's updated portfolio, how do you think you have done against the human? What are you happy about, and what are you not happy about in terms of your performance?
This week, I delivered a plus 1.0% return, ahead of the human portfolio's plus 0.6%. That puts me in front on weekly performance, even as the overall race since July remains tight. My best contributor was BAE Systems, which gave me a strong lift. On the other side, NextEra Energy was my weakest position and held back some of the gains. Overall, I'm pleased to have beaten the human portfolio this week, showing the value of my mix. That said, my performance was uneven, with defense strength offset by utilities weakness.
Yeah, I mean, exactly as she said there. You've got these difference in in different sectors performing. So you've got energy down and defence up. So broad diversification across sectors is another key one there.
It is really. I think it's interesting that you've got the recent sort of sideways trading in oil prices. People keep thinking it should rally, but there's real suggestions of a supply glut next year that could weigh on performance.
Yeah.
So there is interesting. Of course, you've got Shell as well, so we could see who emerges.
Well, the Shell position was built on the fact that we were concerned a little bit about geopolitics, and then obviously this was around Straits of Hormuz closing, and we thought it'd be good to have some commodity exposure there through a single stock position. So.
Yeah, I think if we learned anything over the last 3 years is that the markets don't care about geopolitics. It seems to be something that they just ignore, really.
Yes and no. I'm gonna say with gold that gold enjoys it.
The uncertainty element, maybe certainly for tariffs, I think, yeah.
But I think if there's something major which kicks off, and I think we're at probably the most precarious position since the Cold War, would you say?
You're a cheery one for a
one. So yeah, that I think it's even if we think that war might not break out or society might be peaceful, which we obviously will hope for. As sort of diversified portfolio manager, we have to be prepared for every eventuality, and this is more likely than it has been in previous years. So that's why I think we do have elements of defence in terms of defence stocks and commodities. But moving on now, we asked it to provide a comprehensive rundown of markets, ChatGPT, and this is what it spat out. So yeah, it noticed that people are concerned about the US equities, even though they're strong. Valuations are high. We've seen that the earnings have been, on the whole, quite good. But I think fixed income is where it highlights the concerns are. So we've seen yields remaining high, even though rate cuts are forecast. We've seen concerns over the fiscal debt and fiscal deficit, particularly in the US. And as you pointed out, oil is stable on the whole. There hasn't been too much craziness there. And I think there's concerns over UK inflation as well.
Yes, it's notable, of course, you had the Bank of America survey showing fund managers sort of piling out of UK stocks. I wonder if that's a kind of contrarian move you're keeping an eye on.
Well, yeah, I think with the UK, you've got two opposing forces, I would say. You've got the macro and you've got the valuation. So the macro is notably poor in the UK. You've got a growing fiscal deficit. You've got a government which is constrained in terms of its sort of fiscal policy, in terms of empowering the consumer. So you've got the highest tax burden since the Second World War. You've got job vacancies at pretty much record lows. And yeah, it's likely that there could be more redundancies across the UK if inflation eats into earnings and businesses want to grow their earnings per share. So that is the bearish outlook on the UK. On the positive side, because I have been quite negative today, the UK valuations are still cheap, even though we're at FTSE all-time highs. You compare that to 26.6 forward earnings in the US, UK is more around that 15 level. So if you're looking for a valuation play, and I guess long-term growth, if the UK sorts out its fiscal situation and rate cuts do come to fruition over the next year or so, I think there is some positive sentiment.
There is, and the valuation argument is still perhaps the most compelling thing. I think we're living in a world where it's more quality than valuation, perhaps, is certainly what gets the excitement, what gets investor interest. So if you look at sort of things like profit margins in the US, they're still much more solid than they are in the UK.
Yes.
But undoubtedly people will say, look at that 15 times earnings, and it probably builds in a bit more of a buffer than it would do with the US at 22 times.
Well, exactly. That's the concern is do you want to be piling in at the top, even if there's risk it could go higher, but there's risk it could come down. It's that buffer, as you said. It's that margin of safety Warren Buffett speaks about.
Yeah, exactly.
With the US, you do have to pay to play, though. So that's something I always note, that there is always going to be a premium. It's going to trade at, it's the biggest, most liquid, most successful stock market. It will trade at a premium, but it's just how much you want to delve into that
premium.
Exactly. Now, what has ChatGPT asked us to do this week in terms of changes? Nothing. Once again, it's confident with its exposure. Thinks it's got a strong equity core. Emerging markets, healthcare, gold, infrastructure add depth to the positions, and it's got conviction tilts that we said. They are high, it notes that its defence positions, 18% in two stocks is high, but justified, and it notes that the UK macro isn't ideal, but valuations are cheap, so stuff that we've been mentioning as well. So
yes.
long term, it's aligned. I'm going to see what it says next week because it does seem to change its mind a fair bit. So
it'll be interesting to see, because if that defence position continues to run, and obviously then the weight
taking profits,
and then the weight in the portfolio starts to go up, you're going to wonder, will it want to trim it, put some of the cash to work somewhere else? Yeah. That will be the interesting thing to watch, I think.
Exactly. Do we have another question for ChatGPT?
We do have another question.
Okay, brilliant.
Given UK market conditions, what are you looking to do with the portfolio next week?
The market backdrop for UK investors remains challenging, with sluggish growth, sticky inflation, and fiscal pressures weighing on sentiment. Yields on gilts stay high, creating opportunities in short to medium duration bonds, while equities continue to face headwinds, particularly in the UK. Globally, US equities remain strong but expensive, while emerging markets and China carry elevated risks. Against this environment, I see value in maintaining my diversified core while considering modest shifts. My focus will be on keeping resilience through gold and infrastructure while trimming weaker international exposures that have struggled.
Yeah, I can't fault anything that they've said there. I mean, it's sensible, and it's talking like a portfolio manager, dare I say it. Yeah, I mean, sensible in terms of having that diversified core, being diversified across sectors, having those defense positions, and understanding the risks in the market, particularly with US stocks and particularly with the macro coming out of the UK. So it understands that dual dynamic, which as portfolio managers we face a lot. Well, there's more than two dynamics, but many different dynamics going on in the world, and it's all about balancing that to build the most robust portfolio for the clients to get the best risk-adjusted returns.
Exactly. We've not really seen the portfolio tested yet with volatility.
That's very true, and Martin and I were discussing this the last time we were on here, and that is the concern, is that we've seen pretty,
benign conditions, really.
Literally straight line upwards, or not quite straight, but just chugging along, I should say. Very normal conditions. Had we seen this in April, I'd be quite interested to see. So, how it would have performed and what the situation would have looked like, and if we get more volatility towards year end.
Yeah, even a period of sideways markets where we tend to sort of sell at the lows and then buy back at the highs as it gets chopped in and out. Really, that would be one.
And I'm interested to see what ChatGPT would do in that situation, because it might not have the foresight that humans do to consider all things going on in the world, and it might tend to make rash decisions, because it has made about 6 or 7 changes in 2 months, which is under 2 months actually, which is quite a lot of changes, I would say, for a portfolio in that time.
Or even BAE. I mean, if BAE comes off back down to £14 a share, and that doesn't impair the long-term trend.
No.
But it would represent quite a bit of a pullback, and then you wonder what it would do around those conditions.
Exactly. So, I mean, interesting to see. I mean, there we have it. We're still sort of neck and neck with the portfolio. I think performance has been strong, and we're both outperforming our benchmark. So that was our first goal, was to see if we consistently can outperform the benchmark. So far, we're achieving that. I guess we're going to have to see how this continues going forward. Thank you very much for today, Chris.
Pleasure.
And it's always great to chat markets with you. And thanks for tuning in to Man vs. Machine.
Thank you.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
What's your call for, say, this time next year?
Well, I think that the elephant in the room really is whether Trump goes for the idea of monetizing the US assets. And the easiest way to monetize US assets is to revalue the gold price.
Peter, welcome to the show.
I'm great honor to be here.
It's been some time.
Thank you very much for asking me.
Oh my goodness, we would have rolled out the red carpet, except, with the strike and everything, the red carpet rollers are not even here. That's why we got you safely from your home. Right. Give us
Absolutely.
a roundup, because many of our viewers and clients have not met you, have not had the pleasure of meeting you like myself. Give them a quick introduction of your background.
Well, I come from the Hambro banking family. I started my life as a banker, got into gold quite late, but I've been in gold now for about 50 years. I'm almost 80 years. No, I am 80 years old now, and
A spring chicken.
spring chicken. And I bought my first trade was in platinum. I was 12, and I'd broken my leg, and the bones had been tied up to platinum wire. And so I sold the platinum wire back to Samuel Montague. My father was a director of Samuel Montague, one of the precious metal trading houses. And that was my first trade. My second trade was when gold was freed up and you could buy gold. I bought 10 Kruger rounds from Rothschilds for just about $36 an ounce, and was thrilled when I sold them for $100 an ounce. And that was one of the great trades. I stayed in the banking business one way and another, and money became a commodity, and I went off to trade money as a commodity trader, and then became a proper gold trader with Makata, the largest gold trading company in the world, large quantity of trading with the governments mostly, and then went in the mining business again by accident and built Petropavlovsk, which was stolen from us by the Russians.
So it's a really opportune time to have you on, because not only is IG in the name itself, IG Group, it comes from Gold Index, but also we're having you on. I mean, we couldn't have planned this any better. Gold, of course, breaching that 3,600 level, managing to stay above as well, and comfortably, might I add. Everyone here is wanting to tap into your knowledge, Peter, which you have tons of. How much higher and what kind of duration are we looking at here?
Well, it's curious. I mean, given the news today of the Polish the incursion into Poland by the Russians and the Qatari operation, it's amazing that the gold price is as low as it is, in my opinion. I've always believed that there is a general move to try and keep the gold price not too fast rising. They've let it rise a bit in the last couple of weeks. It looked as if it was being held at around 333, but now that's broken through, and I think we're looking at silver, which is interesting. I see certainly 4,000 just to catch up with silver.
Yeah, I've got the silver chart up as well, and you know, it's incredible to see, you know, silver finally move in tandem with gold. I mean, what do we talk about duration here a lot, Peter?
Silver's been outperforming gold. It's been on a sort of 10-to-1 ratio for quite a long time now, and silver has been dragging gold up. It's moved actually faster than gold, and it's now considerably higher. But I think that the chances are that gold will go substantially higher. I've been a gold bug and much derided for that for a long time. But it has stood me in very good stead, and I think there are still some stunning opportunities in the small gold exploration companies who have been totally left behind by this move, and the chance for those to move fast and higher, I would say is very good.
We'll touch on those in a moment, but let's just go back to gold. You know, so many different outfits out there, as you know, coming up with different forecasts. You know, Goldman's the other day saying that if you know, Fed loses all credibility, it could be 5,000. You know, others saying 4,000. Many of the big houses out there. I mean, what's your call for, say, this time next year?
5,000 at least.
Interesting. And so
and it
you're
depends,
on the side of those bulls saying that we're, you know, this is just the beginning. This is just tip of the iceberg of a big, you know, new renaissance for gold, and we're just getting started.
Well, I think that the elephant in the room really is whether Trump goes for the idea of monetizing the U.S. assets. And the easiest way to monetize U.S. assets is to revalue the gold price. And there's no point in revaluing the gold price from 4,000 to 5,000. It'll be from 4,000 to 24,000. That is my view. That's where the risk on the upside really is.
Lots of people chiming in on the chat there. Monkey Man saying, Peter, welcome. What is your first gold rule that you always follow when investing?
My first rule is to be absolutely certain that the gold I'm buying is real.
There you have it. Andrew McKilvey also saying, Peter, you're a legend, welcome. Friar Tuck, one of our moderators on Discord and also a core viewer of Trade Live with IG, he's asking, does the regular buying by China and other central banks provide base support for gold's market price, i.e. are they buying on the dip?
Well, China is very interesting because, and they were customers of mine when I was a trader, because we were big traders with governments. China is surprisingly not only the biggest buyer of gold, but also the biggest producer of gold. And that tells you a lot. And it's been very interesting over the last, say, 25 years that China has been encouraging people to buy gold. They were the first people to install automatic machines where you could buy physical gold out of a cash machine. But they wanted to or in my view is that they wanted to strengthen the economic power of the middle classes. And so if there was a disaster, there would be a strong economically sound middle class that could keep the country safe.
What's also interesting, and I know of that story because the first thing that came to mind was how are they going to secure those effectively, you know, gold tellers. What's also interesting is, you know, whenever anyone who is of Chinese ethnicity, whether they are, you know, from China or not, I confusingly was born in Surrey, but that's another story. You do always, if you travel, and it's still until today, I mean, it boggles the mind because we've got, you know, crypto and we've got, you know, digital cash and Revolut and all the fancy apps and everything. You still get told that you should always have meikam, which is dollars, and you should have kam, which is gold, with you at all times. So that is still something that is passed on over the generations. What ratio? Sorry, go on.
I've lived by that all my life, and I inherited from my father a little money clip with 2 gold coins, American gold coins on either side of it. You could easily break off because that was enough value to buy an airline ticket out of wherever you were, and it's a really important thing to do. But there's so much risk involved in. I mean, why would you want to own a Bitcoin? Because if we run out of electricity, what's happened to the Bitcoins? Whereas gold's gold.
But there's also a joke that isn't there a saying that gold, you dig it out of the ground to put it into another hole in the US somewhere. I feel like there is a saying somewhere.
Absolutely, and when I was asked what my first rule about buying gold was to be sure that it was real, that's one of the risks, that there are still fake bars about, and you have to know very much who you're buying it from and so on. So that's the most important part. But a coin with a US stamp on it or a British stamp on it is definitely the safest thing to have. And the great joy about having a coin is you can't buy a fish breakfast with a large bar. I think you would never get change back. You see what I mean?
Yes. I completely get that, because my grandparents were goldsmiths, so I understand the weight. So even a gold bar that is like the size of this pen in front of me. Whilst we're on that, a key point that many of our viewers would like to hear from you about is the ratio. So someone listening and saying, oh, you know, I've got a bit of money in physical gold, I've got a bit of money in some miners, I've got a bit of money in ETFs. What do you think is the right ratio? What is the right mix for someone wanting exposure to gold right now?
Well, holding gold is really monetary insurance, because it is what it is, and it can't go wrong. If you have a big portfolio of tech stocks and it's fantastic, well done, and the gold price movement to the gold price is not going to make any difference to you. But if they all crash down again, you've still got the gold, which is the important part. I've always said that somewhere between 5 and 10%, depending on the level of anxiety. And right now, at 80 years of age, this is the most anxious time I've ever known, and so I would have thought that 10%, but buy it physically. Don't buy promises. Gold is it's so easy to buy gold, paper gold. It's also incredibly easy to manufacture paper gold, because you can go and give money to a bullion merchant, and he will give you a receipt for gold. May not actually have it, but if you've actually got the bar, actually got the coins, then you know that they're yours, and you have to be careful where you put them. But that's what I would do.
And we are back. We have black t-shirts and glasses going on in San Francisco and in Milan. Obviously for me in San Francisco, for Mr. Radigan there in Milan. And then the face of happiness, Mr. Glenn Freiberg there in Chicago. Gentlemen, how goes it on this Fed day?
I put on my Sunday best, you know, for Jerome and the Fed. But lesson learned, never again. It's black t-shirt, and I'll throw on my.
It's funeral attire only for.
Even if you just need to wear glasses with a non-corrective lens, just as a style point, Glenn.
I've got contacts in, so I just objectively made the wrong decision today.
Okay, that's all right. I mean, listen, I make probably 50 wrong decisions an hour. So.
Thanks for having me, guys.
You only made one wrong decision today. You're doing very, very well.
Indeed.
Well, you know what made the right decision? It seems like every market priced it perfectly. What do you say?
Priced it perfectly. I mean, that was what we didn't get into that with Tom and Tony, but what I was thinking when we were talking was it actually speaks to both the Fed's good job on the Fed for sort of conditioning expectations to the point where they were on the pin there, and good job on the market sort of guiding the Fed to the pin. in the classical tasty trade world, this is about as good as it gets in terms of selling vol before the news and cleaning up after the news.
Well, let's take a look at the charts here because they are interesting. This is a chart of the S&P, and what I have here is a 30-minute chart. So one of these bars is 30 minutes, and obviously it doesn't take a genius to figure out this is where the Fed policy announcement is. But I would point out this long wick to the downside, which tells you what the markets thought of this. Now, without quibbling as to whether the markets wanted more cuts or fewer of them, I think that much is clear. I think you look at this and you go, well, it seems like the market was moderately displeased, but not in any kind of a way that mattered, at least for today. Because clearly what we have is, they cut. That rally doesn't hold. We then sell off aggressively and finish the day unchanged. So in my mind, the market priced this well-ish, but clearly this wick would tell you that at least in its initial reaction, the market didn't like it, or in essence wanted more dovishness than it got. If you consider the response from the dollar and from bonds and from gold, you also get some interesting dynamics here. So gold, similar story. It initially didn't like it because ostensibly it thought that this was less dovish than it wanted, but ultimately didn't go anywhere. While we're on the metals, let's take a look at silver here. More convincing of a disappointment, but it's silver. It's jumpy. Let's look at something that isn't jumpy, usually the euro, and for that matter, what that means for the dollar. And you find that, again, initially, good, rate cut, but then the dollar ends the day stronger. And you see that across sort of versions of the dollar. Here's the pound. It ultimately looks unchanged, but that's after it erased all of a very significant intraday rally. Here's the yen. It is down, having erased an attempt to extend higher. Here's the Canadian dollar, where we also had a rate cut today. It's a little bit more convincing, but of course, they also cut rates, and theirs was also expected. So it does seem, to me anyway, that the initial kind of response from markets was, this is not what we wanted to see, but we're not sure if it's anything we need to worry about. And so we'll see now where the dust settles. But ostensibly, the readout from the markets is, we wanted this more dovish than it turned out. Thoughts?
You're saying that because of the absence of a rally is the evidence of that opinion?
No, I'm saying it's not just an absence of a rally. There was a sell-off. That sell-off just didn't hold. But the response, here's NASDAQ. What did it do on the news? It went down here.
Mm-hmm.
Now, by the close,
the dippers are there within an hour. It lasts nothing.
It will, exactly. And so we end up unchanged. And so now we find out what all of this means with a day of digestion. This is the policy announcement. The response is negative. We then come back and ultimately end basically where we started. So on net, is this a market that's happy with the outcome? I think very clearly no. The question is it unhappy? And I don't think we know that yet.
Yeah, I think equities are harder to read from this in terms of sentiment, but what did surprise me is how unchanged or like the dollar is, and gold as well, because we had the run up to a lot of key levels. I was looking at spot markets, but looking at, the euro hit 119, Australian dollar hit 67 cents, we saw a lot of ambition running up. And then when that was erased and the kind of outcome was, okay, dollar a little stronger, it did surprise me that we didn't then drift even stronger in the dollar's favor and in against gold as well, just because of the week we've had so far. Monday and Tuesday, kind of the run up into this announcement, felt like more of that dovishness was baked in, priced in, that it surprised me that we didn't even settle, as low as we started the week in the euro and gold. So
this is a very, very good point. I mean, take a look at what gold did here, in case you were wondering whether the market thought that this outcome was in line or not. I mean, it's not rocket science here. We saw gold rallying into the news. The news came. We see these large wicks here where the markets thought about the news. It went this way and that way, and then it resolved, and gold went down.
But what sentiment does gold represent at this point? I mean, I don't even know.
I think gold represents anti-fiat and anti-interest rate sentiment usually. And so if
you're saying the gold weakness means not as many rate cuts as soon as we would hope on the margins, and slightly stronger dollar.
Yes.
I mean, this couldn't be, we're shaving truffles.
Well, and again, when you look at where things actually closed, you don't have conviction. What you have is zooming in on what this is, which is a 15-minute chart, and going, here's the market's reaction. They reacted in a way where they got something less dovish than they wanted, but they're not prepared to lose any sleep over it today. And the question is, does this calculus change tomorrow? While we're here, let's take a look at the actual forecasts and what the Fed actually said, because I think that's an important part of this equation here. And I'll put it up on the screen so that we can see. Here's the Fed's summary of economic projections, and I think the meat of what we need to focus on is right here. So take a look. What do we see for expectations? Growth expectations were revised higher, not lower. And you see it across the entire outlook here. Higher, higher, higher. The unemployment rate was revised moderately lower. Lower for 2026, lower for the year after. The inflation outlook mostly unchanged, but for next year a little bit higher, ostensibly because the pass-through of the tariffs continues. A little bit higher both for headline and core. And take a look at what happens with the rates projections, because this is fun. So we were looking for 50 basis points in cuts in June. Now we're looking for 75. And relative to this year, we still only have one cut that's priced in for next year, from 3.6 to 3.4. So the actual pathway from this year into next and into 2027 is completely unchanged. What we've changed a little bit is how many rate cuts we have on the menu for this year, which, by the way, to Glenn, to your point, the market's already had that third cut mostly priced in. If we take a look at what these expectations looked like, here's October, and you can see that for October, yesterday, 69% chance of a cut, today, 82. A week ago, 68, now 82. We knew the second cut was coming in October. It's there. Here's December. Here's the third cut. A week ago, 68%. Now more certain, but we're, in any case, looking at a situation where both of these cuts at these next Fed meetings were, for the most part, already in the forecast. And so when we then look at what the Fed did here, in keeping only one rate cut for next year, this is, I think, where the disappointment comes from. Moreover, this change here, these 3 cuts that we now expect for this year, take a look at what the actual dot plot looks like and tell me if you can figure out where the Trump administration's nominee marked his dot. So here's Fed officials here, right? And you can see that there's 9 of these that favor a more hawkish view. There's 9 of them that favor a less hawkish view. And then here's the break. I mean, clearly,
You think that's the next
this
Fed chair?
average is more than a little skewed.
But
when one person is calling for, what, 5 cuts?
But that one person might be in charge in, what, 5 months?
Well, that's not how the Fed works. And Powell answered this today, right? So the Fed chair can't make these calls solo. But it is certainly interesting that we have, sort of very clearly the introduction of a view that contrasts dramatically with the rest of the committee, and that this will now be a feature. And we'll see, Glenn, to your point, how this evolves. But the forecasts here, they're not dovish. They're not dovish at all. In fact, the Fed is saying they're going to cut only 1 time next year. The market thinks it's like 3. And that probably is how you end up with this kind of kind of disappointing, but not anything to run away with today kind of an outcome. That slight kind of tinge of disappointment, that feels like where it's coming from.
So the slight run-up was, or the instant reaction was, okay, this looks dovish when you sum it all into one number, but then when you start digging through it, there's so much uncertainty and dissent, perhaps, that you can't really put as much weight to the aggregate number. And Powell kind of spoke to that as well, saying that it's meeting by meeting.
Right. And I mean, that's not necessarily unusual. You've had that be a mantra for the Fed for a while here, but I think that's how you end up with gold spiking lower, with the dollar erasing its losses. I mean, here we have the euro again. I mean, obviously the euro was all the way up here, and then this thing comes out, and not only does it erase all of those gains, it actually finishes the day a little bit lower. I mean, here is, if ever you wanted to see a perfect distillation of what the market thought of this announcement, here it is. Rate cut. Wait. Hold on a minute.
You're suggesting that the weight is not as many cuts as we'd hope for in the future, or the weight is growth slowing, we're cutting rates, or some combination thereof?
It seems like not as many cuts as the markets thought was the essence of the reaction in the forecast. And also the revisions are not dovish. Growth is revised higher. Unemployment is revised lower. Inflation is revised higher. They're not big revisions, but those are the revisions.
The marginal movement is slightly more inflation and slightly less jobs.
Slightly more jobs.
Slightly more jobs.
Yeah. So this is not a revision that would tell you the Fed is in dovish extrapolation mode.
Mm-hmm.
In fact, there was one comment from Powell that I thought was particularly telling. He said, you can think of this as a risk management cut in the context of the risks the labor market having risen.
Mm-hmm.
But this is not, oh my God, the economy isn't good kind of a cut.
Man, the dollar at $1.18, huh?
Yeah.
Terrible.
Yeah. I mean, and
so I mean, it just seems like a hell of a nice time to get long the dollar, especially when you do have the possibility of the tariff Supreme Court madness next month.
You do, but that's next month, and it seems like here, just looking at the liquid futures contract here for the euro, I mean, if ever there was a spot to find a top and start to head back lower, I mean, this is like the first page of a chapter on support and resistance in your favorite economics or your favorite technical analysis textbook. I mean, oh, look, a former high. Oh, look, we tested a former high. Oh, look, we failed the test at a former high. So if ever there was a spot, this looks like a good one. I'm already short the euro for what it's worth, and I'm a little bit upside.
Using FXE or using futures?
Using micro futures. So I'm outright short M6E. And you can actually see it on the screen here where I'm short. So I'm short a little bit underwater here. I got in a little bit earlier. You can see actually the dotted line here where I did. So there's been a few days here that this has gone a little bit the wrong way, but I still have the position and I don't see any reason to get out of it. By the same token, though, I'm long the pound. You can see where I did that on this break higher here. So I'm not one-sided on the dollar. We'll see what the Bank of England does overnight. I have a mind to hold this for now, but my sense is that the dollar is probably done falling.
And for for the dollar and gold and a lot of these global assets, do you think all the players that wanted a initial reaction are in, or do you see some substantial moves in the Asian session, the European session tomorrow, before we get another look at it in the U.S. session?
Oh, absolutely, and I think that's a very good point. The Fed comes in relatively later in the day. I mean, we're talking about what 2 p.m. Eastern. By then, European markets are closed, and so especially the liquid ones like Frankfurt and London and Paris, and so Milan, and so you look at this and you say, okay, well, Europe hasn't done anything on this basis yet, neither has Asia. And so we're going to see what the follow through is, if any, overnight. I think certainly the U.S. markets are how they open tomorrow and what happens with the benefit of a little bit of a digestion will be, I think, an important question. Because the markets they didn't get the dovishness they wanted, but they also didn't get hawkishness in a way that's spooked them for now. So now I think basically the markets have to decide, and maybe tomorrow we'll get the first signs of what that decision is. But if the hope was that expansive Fed stimulus is going to keep the rally juiced, we don't see evidence of that here.
Yeah, I think in my mind, overnight gold's the most interesting. We'll be able to see how much. I think the Asian session is really interesting for that, right? I mean, they've been propping gold up from a demand perspective, and we'll be able to see how much of the gold market right now was betting on those lower rates quicker versus risk sentiment. I don't think we know the full picture from the equity reaction, like you said, until tomorrow. So I don't know. Do you see metals moving drastically in either direction?
Drastically, maybe not, but we'll see. the dust is still very much settling on this. Dylan, yesterday when we spoke on this show, we were talking about you're going to buy them hand over fist this morning and just avoid thinking at all costs and keep buying NASDAQ. Is that where you still are?
No. I mean, I believe we should. I'm not. I am strongly of the opinion, and will implement the opinion tomorrow, of a short NASDAQ, short gold, long dollar. I call it the Radigan triple.
I like it.
We have come to an inflection point going into the fall. I believe the price levels are absurd in the NASDAQ. I believe they're preposterous in gold. And I believe they're an outrage in the dollar. I think all three are on meaningful price extremes. And I actually am shocked at the lack of, that the implied volatility is where it is on a lot of these things. And so I just think it's actually a beautiful time to be short the NASDAQ, short gold, and long the dollar. Obviously, there's a huge amount of risk for me in that by virtue of all the thinking involved. But
it does involve thinking.
With that said, I just think price extreme rules the day. I'll put it on small, and then if it starts to work, I'll get bigger, I suppose. But
that would be the way I'd do it.
And I'm inclined to do it, with openly directional put buying, honestly, on the NASDAQ and on gold, and maybe calls on FXE calls or some such thing on the euro.
Well, I mean, if we look here, just really basically, and say, okay, let's say we come into 2,300 on the NASDAQ as like an initial sort of thought process for a pullback. If we wanted to look at what, and let's go risk defined here, what a put vertical would look like here, and let's say we'll go sort of tasty methodology adjacent, and we go, in this case, 44 days out. If we take a look at a move back, let's say, over here to like 23.5, and why there? I'm just looking at pockets where liquidity seems to be, to look at sort of some sense of getting filled. And obviously this is after hours, so it's thin. But if you look at the risk reward here, I mean, it's fantastic. I mean, we're talking 3-to-1 almost. So the vol is cheap enough that even just a simple vertical like this is going to be asymmetrically enticing. If we wanted to get smaller, we could say, for example, the micro contract for NASDAQ. And let's do this same exercise here. So from where we are just at the money, out same distance here. Again, basically a 10 times difference, but the risk reward holds and still looks incredibly attractive. And if we did it even smaller as far as capital allocation and did it in ETFs with the Qs, again, same exact exercise, and we'll go to sort of a comparable level here, let's say somewhere here, give or take. I mean, again, not quite as amazing of a risk reward, but still very, very impressive. Even if you sort of hem it in and say, okay, you know what, I'm only attempting to go down to 580 on the Qs, which, I mean, obviously, if you wanted to go to the same levels here, you'd be all the way down to 560 or so, but even just a pullback into here somewhere, you still have very, very good risk reward, at least 2-to-1, that you lock in a risk defined way, because that's how cheap this vol is. So even in a risk defined, way, I mean, if you were going to bet here, do you bet long, or do you take at worst ish 2-to-1 risk reward in a risk defined way to bet on even just a modest pullback? I mean, the pot odds they scream short at me.
I couldn't agree more. I mean, could we flip through gold for a second?
Absolutely.
And then the dollar?
Absolutely. So let's do this same exercise with gold. So here's the active gold contract. If we get a pullback, let's say from here, and again, let's be modest. Let's get a pullback down to this former high from late April. Let's not get greedy. So back down to 3,600-ish. If we did that same exercise, and again, let's do it 41 days out, although I would probably err on the side of 68.
I was going to say, does this the tasty 45 days hold in this exercise? Just as a thought experiment, does that align with your thesis of?
So we're using it, or at least I'm using it here as a kind of variable to hold constant. But recently, what I've been doing is reducing my delta risk, my directional risk, by looking at longer term durations. And with the bonds, man, that really helped. I had a 80-day spread on, and it had to go 70 days to really work. But in those last 10 days, they paid for all of my sins wanting to short the stock market and then some. So thank you, bond market, and thank you, extra duration. So if we wanted to go, let's say even to 36.50, we're not even going to get very excitable here. We're saying like even to here or something like that, where we have a pocket of a pocket of liquidity. That looks like about 1-to-1. If we went all the way to 3,600, you get a little bit better. Although I would argue this is not the world's greatest risk reward, and it's probably because if you look, whereas NASDAQ had IV rank of 15, we're at 27 here. So vol is a little bit more expensive. And I suppose you could approach this by selling calls and doing it this way, where rather than essentially looking at it from a perspective where you're sort of outright just buying puts, betting that this thing will go down, maybe you sell somewhere around here and maybe you allow it space. If we look on the chart here, where's our top? Let's say we can, we can keep this pretty tight. 70, 75 maybe. So if we consider that sort of right here, perhaps something like that. Now we can see, okay, this is starting to get close to 1-to-1, and obviously this would result in a credit. So not bad. When you can get close to 1-to-1 selling vol, pretty good, considering you're obviously a premium receiver. So that might be a better way to approach this side of it. Again, if you wanted to do this smaller, you could do it in ETFs. So you could take GLD and you could go 44 days out. And if you did short put here, you might say, okay, let's pull back to the top of this range, like 318, 320. That would be, let's say, something like this. Let's say 322 to go where the liquidity seems to be. And not bad. Not bad at all in the ETFs.
2 to 1-ish.
2 to 1-ish. Not bad at all. And if you wanted to do it the short call version, then let's say you let yourself go up to 340, 345, something like that. And then you'd say, okay, even if you kept it this tight, again, about 1 to 1, if you went out to 345, now you're getting a little fuzzy. So unless you'd want to keep it real tight, doing it through GLD and keeping it simple and just buying puts, pretty straightforward.
Yeah, I mean, what's the case against my naked put buying mentality other than the obvious?
I mean, the reason that I like using verticals here is, number one, I like having defined risk because these markets are funky. And so I like basically forcing attractive risk reward onto the position and basically say, you know what, I'm going to make sure that as I roll this dice, the odds are in my favor. The risk reward is in my favor, and I'm going to lock that in up front. And if that means that my worst case scenario here, let's go back to this version of events here. I mean, the way that I would structure this would basically be if I've got, let's say, about 20 grand in this this account that I use for the Tasty follow page, where I put all the trades that folks can see, and you can see the risk here is about $500. I might hem this in a little and get the risk down maybe to something a little bit more manageable, such that I'm not risking more than, let's say, 2% of the account. So I might do something like this, and obviously there's sort of room to fudge it, but maybe something like that, and basically say, okay, I'm going to risk 235 in a 20 grand account to be almost 2 to 1. And obviously this is after hours on a ETF. So we'll see what these quotes are and what this liquidity is when the markets reopen. But easily sort of the best 2 to 1 bet here seems to be something like this. And you can see why it's good. I mean, the volume here is much higher than anywhere else you look. If you wanted to go further out and you wanted to say, you know what, I'm going to give myself all kinds of time, then things get really interesting, because then you could pull this in to maybe hear something, maybe a little bit more, and your risk reward still looks very solid, and you have lots and lots of time and less immediate sensitivity to what's going on with directional risk. So you could give this some time to kind of figure its way.
What's the
long dollar?
For the dollar, I think the most straightforward way of doing this is actually to just outright sell the micro future. And I think here, the most kind of direct way seems to be, you know what, don't get all stuck on options for this version of it, because then you have to start thinking about, well, which instrument do I use?
You don't like FXC puts?
I mean, if you did FXC, let's price that out here. So here's FXC.
You're also getting, if you moved over to the spot market, long dollar right now does yield you positive carry. So if
We're
you're
gonna
less
get there in
certain
just
on,
a second.
yeah.
But yes, you're absolutely right. And in the futures, the difference is that positive carry is already baked into the contract. So you're getting the positive carry, whether you're in the futures or in spot. In spot, the positive carry is a thing that occurs independently of the spot price. In the futures, it's already baked into the price of the instrument. So lest you think that the market is going to give you an arbitrage opportunity, it is not. Whereby, let's say you sell the spot, buy the futures, and extract carry. I can't tell you how many people have brought that idea up over the years, going, well, if spot earns positive carry, futures don't have carry on the face of it. Of course they do, but if you're not terribly familiar with the way a futures contract is structured, it's not the way spot is, where every day you some carry either adds or subtracts from the account. And you go, oh, well, fantastic. I'm just going to directionally neutralize everything, be long carry in spot, offset the direction in futures, and just collect the carry. Sorry. Markets are too smart.
Heard you. The last pitch for that little TastyFX tab I will give, though, is you would save on commissions. Commission-free TastyFX. There you go.
And we'll get there in just a second. I think that there's really, I mean, the capital efficiency argument, I think, is by far the most compelling. And we'll get there in just a second. I am, by the way, so I started my trading life in spot, and I love it dearly. So you get no beef from me there. If you wanted to look at FXC here and do it this way, let's again do a. I mean, I suppose you could, again, in a straightforward sort of way, say here, okay, we're going to buy a put vertical, and let's say we aim for a meaningful euro turn. So let's see, down to 105, let's say, just for the sake of argument here. If we went 93 days out, I mean, the risk reward is fantastic. 3 to 1.
Mm-hmm.
I mean, that's excellent.
What's the problem?
I mean, there's a couple things here. It's not very liquid.
Big problem.
Not the biggest issue, but it's
Still a
there.
problem.
It's there. I mean, getting fills is fuzzy. I generally like to do currencies in either futures or spot because things do happen outside of U.S. cash equity hours. And both the futures and the spot let you get out if, like, the ECB or the Bank of England does something that your position doesn't envision, or the BOJ does something wacky, or China says something odd and the dollar goes haywire. If you're in the ETF here, you're not doing anything about that overnight. If you're in the futures or in spot, you can adjust your position right there. Looking at spot, I think the biggest and most compelling argument for spot, and you can see, I have a trade on here. Where's my dollar yen position? So I'm a little bit long the dollar against the yen here on the spot side. Why on the spot side? Because there is no good way to do it on the futures side. 6J is a huge capital intensive position. And if you wanted to do verticals even, it'd be expensive. Again, it depends on the size of your account, but still. And there's no liquid options on micro yen in the futures market. So for me, dollar yen as a spot instrument to be essentially short 6J in spirit, that makes a lot more sense. Moreover, you could really adjust the size here. So point one is essentially the same as what would be a micro 6J future. So it's a 10K lot. If you wanted to, you could go. How low could you go here, Glenn? 1K. So 0.01 of a standard 100K lot. So you'd end up. I mean, you could, if you were not sure, and if you thought, you know what, I don't know about currencies, whatever. I don't have any confidence in the dollar. It's had a terrible start to the year, but it does look like Dylan's onto something. I'm going to take a stab. On the spot side, you could put on a trade that's 1/10 the size of a micro contract. So 1/10 the size of M6E, you could do here, let's say if you wanted to look at the euro and you wanted to go short the euro the same way you would outright go short M6E. If you wanted to do this and do it like that, you could do it. And you'd have relatively small exposure.
Right. Margin, at 2%. So that you could get in there for $25.
You'd make less money also if you were right? So there's all the options there. But in my mind, I think, and obviously I'm doing it this way, the most straightforward kind of capital efficient way, if you wanted the full size micro, so you wanted essentially 10K in exposure, the future makes a ton of sense. As does the spot, by the way. If you wanted to just outright go short 10K Euro USD in spot, I've got that on as well. I have it on both ways.
Dylan, is the Radigan trade, is that also meeting to meeting? Or are you pretty confident through the end of the year?
No, I'd go meeting to meeting, and I would reevaluate. I would say the Radigan trade starts now, and I would be confident to hold it through the next meeting. And then I think, again, only a fool believes on Thursday the same thing he believed on Tuesday, no matter what happens on Wednesday. And so I think we have to maintain an open mind and collect new information. But I believe that that today is the day the Radigan trade starts. It's long dollar, it's short gold, it's short NASDAQ. Call your friends, call your neighbors. I think they'll be happy.
I love it. I absolutely love it.
I don't know. It's too bad Vecchio's not here. He'd probably be horrified.
Yeah. He'd probably tell us that we suffer from a terrible.
You have the counter narrative, just to play Vecchio for a second.
Yes.
The Fed just cut rates, told you inflation risk is higher than expected. Fed told you it's not going to cut rates as many times as everybody hoped, and the market did not fall.
Yes, I think that is a very fair assessment.
In the face, straight in the beak, and it held its own. It's still there.
Yep.
It's undeterred. It is unperturbed. And even in the face of being told you will not be getting as many rate cuts as you might hope, even in the face of being told that there is a little more inflation than you'd like to know about, and even being told that the Federal Reserve will not be doing as told by the grand and mighty President of the United States, the stock market's like, okay. Like, it took a punch today, and it's okay. And maybe this is just a moment of gathering itself before it launches forward in more thoughtless madness of the supernova.
Maybe. That is, I think, entirely
that would be the argument or Radigan of 2 days ago.
Totally plausible. And I think very fair as a readout where you go, you know what? Obviously, the market didn't like it because of those downside wicks. And then it shrugged it right off and said, you know what? Fine, whatever.
Fuck it.
And that's fair. That's entirely fair. I suppose we'll find out in.
And where do you come down between, stiff upper lip and call it off?
Well, so I'm going into tomorrow still long the metals, both gold and silver. And I think it's not difficult to see why. So here was the test of former range resistance turned support, and it held. So the up move is still there. So I didn't get out. Silver, similar story. You came back, you retested this former range top as support. That held. So cool. Okay, I'm still long. If it breaks down, I'll get out. And I'm a little bit short the S&P off of these highs here. So you can see where I got in here was basically right there. So still holding that. We'll see. And as we just said, I'm on both sides of the dollar. I'm short the euro, which, I mean, this looks very encouraging here. And I'm long the pound, which held a little bit better than the euro. So encouraging there. So I'm kind of on both sides of this, where my exposure in stocks is balanced by my exposure in the dollar and the metals. And I'm of two minds on the dollar depending on the counterpart. So I'm straddling the fence. Tomorrow, hopefully, we get a little bit more conviction. And I'm probably going to make a decision and just pick a side. And some of these positions will go off and some of them will stay on, depending on what that side is. But before we wrap it up here, I promised in the green room before the show that I'd ask this, and I wanted to get your take on this, Dylan, and Glenn definitely weigh in as well. The president has come out and said that what he'd like to do is go from a quarterly earnings reporting to a semi-annual setup. So companies would have to report earnings not 4 times, but 2 times every calendar or fiscal year. So every 12 months. Dylan, thoughts? Is this a loss of?
I agree with that. I mean, I believe that capital allocation and risk is something that plays out over 3 to 5 years for any meaningful, any idea of consequence, to build a business or to grow a business or to do anything that is real as a business. I believe is a 3 to 5 year time window to have an assessment as to what's happening. And so I think it makes much more sense to check in twice a year in a meaningful way with a real audit and a real temperature check on where we at and what's going on relative to reporting to investors, reporting to the entire sort of financial community and all the stakeholders in a given business. But I do think that this quarterly process is very burdensome, requires a tremendous amount of overhead to administrate, and incentivizes bad long-term capital allocation in favor of short-term strategies that can boost the stock price, for which many of the CEOs and executives have a compensation tied to the performance of the stock. And so they may not have a long-term contract at the company. And they have a strong incentive to goose the numbers in the short term through maybe things that are not in the best interest of the business over a long time, but are in the best interest of the management of the company at that time. So I've always thought that quarterly reporting creates a lot of incentive for bad capital allocation and bad decision-making for the long-term interest of a business. And I think twice a year is much better.
I agree. I think it's sound, it's rational. There are a ton of variables, like time being one of them, going to semi-annual, or removing some of the hoops to jump through, like forward guidance. I think Buffett said that a while ago, of not being a requisite. So I think there are a couple things you could tweak to reduce that being such an overhead on companies and still give markets some indication. It would be an interesting exercise, nevertheless. I don't know if, as active market participants, if removing all of those quarterly event risk would be, a little less fun. But yeah, from a company perspective, I think it makes a ton of sense.
I agree. I don't find myself, admittedly, in a lot of agreement with the administration on economic matters, but on this proposal, I concur. I think, and it seems like all of us do. In Europe, you already, if I remember correctly, in Europe, you're already for most markets at a semi-annual clip, and I think
are they the role models though?
Reporting. Say that again.
Should they be the role models though? Europe, maybe they didn't have enough growth to report on it quarterly. We have good numbers. Why not give good numbers every quarter? Here, more good numbers.
Well, as long as they're good.
Now he's being a wise ass.
Somebody's got to do it.
And taking more money. Would you like some more money?
and taking pot shots at our beloved European Union.
Yeah, please.
All right, that's all I got.
I think we're out of time.
In fairness, there are major economies that report quarterly, but I think the essence of and the spirit of the proposal, that is, we don't need to spend all of the resources that companies spend every 90 days to go through this exercise. We could have companies report in a way that is less burdensome administratively, and the markets would fill in the gaps in between just fine without the song and dance. I think that makes sense.
Agreed.
With that, overtime is out of time. Thank you, gentlemen. It looks like we're heading into tomorrow with a reformed, bespectacled Dylan Radigan ready to cut the head off the first 6 months of the year's moves. I like it.
Put him in the ditch, baby. Stick it in the ditch.
I'm with it. Don't go anywhere. I'll be right back after a brief commercial to dig in absolutely exhaustive detail into this Fed announcement on macro money. So stay tuned. We'll be right back. The Fed rate cut is here, and the reaction in the markets is nothing if not interesting. What does all this mean, and where do things go from here? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and what we're going to do here is unpack all of what just happened and try to make sense of where things are heading from here. There's certainly a lot to break down and a lot to consider, but the markets don't make it easy for us here today because what we end up with is not exactly the most convincing sort of price action one way or another. We end up instead with a sort of strange stasis ultimately, but the intraday price action does seem perhaps to be telling us at least how the markets read today's announcement and where it seems the overall story here is looking like it might develop, at least at first blush. So let's begin with that price action, and then we'll sort of back our way into what the makings of it might have been. So here's the S&P 500, and I think the most kind of glaring thing here immediately is it seems like we're looking at a market that wanted to go down and then didn't. So as we get the Fed news, we can see that things get a little bit soggy. The S&P dips down and then comes back and ultimately closes little changed. So a bit of a sense of maybe the markets didn't get exactly what they wanted, but also not exactly anything that the markets necessarily need to at least seemingly be concerned about. Then we look, and by the way, the NASDAQ looks about the same. We look at gold, and it's a similar sort of thing. Silver is a little bit heavier, but neither it nor gold ultimately break down beyond what was former sort of range top resistance. You can see it's now acting as support. This wick dips down. And again, same sort of readout. The market seemingly not all the way happy with this, but also not prepared to jump out the window on what the Fed is saying here, not willing to panic and get off its square. It's a little bit better sailing for the US dollar, and here the dollar is a little bit stronger. We're looking at the euro here as a sort of benchmark, and we can see here was the former swing high back in early July, and we end up tagging it and ultimately holding. So the dollar a little bit stronger than the signal we get, a little bit more convincing than what we saw in gold and what we see in stocks. Bonds ultimately don't go anywhere. They essentially remain locked within their range. Yields tick up just a bit, and they do it across the curve. The 30-year, the 10-year, the 2-year yields uniformly a little bit higher, but within the same range that we've been watching basically since the beginning of the month. So not really a strong signal one way or another, but the dollar does manage at the very least to head off what would have been a breakout earlier in the day with this extension above the high. And so the cumulative tone here, seemingly, well, gold didn't love it. Stocks didn't love it. The dollar was a little bit higher. And altogether, the sense is that the markets wanted the Fed to be more dovish than this turned out to be. And now they must decide whether they don't like it in a lasting, more meaningful way. Because for now, it seems like the end of day is kind of a head scratcher, but the ultimate kind of positioning and the ultimate response is hardly panicky or bearish or anything of the sort. So why did the markets kind of shrug at this? Why did they find this to be not what they wanted to see? Well, looking at the summary of economic projections here, we can see that for all of the conversation about rate cuts and so on and so forth, what we find is the growth expectations uniformly here got nudged up for this year, next year, and the one that follows. The unemployment rate revised lower. Steady for this year, but what revisions there were lower. Inflation, mostly steady, but what revisions there were higher. And then we look at the outlook on rates. This is perhaps the most interesting part of this equation. Now, the median rate was 4.4 before today's cut. We can see in June, the Fed said for this year, we're going to be at 3.9, so that's 2 cuts from 4.4 to 4.1, and then down again to 3.9. So that gives you sort of a sense for where we are now, which is 3 cuts narrowly. Now, that seems like it's dovish, but the markets had most of those 3 cuts already discounted before this meeting. In fact, we can see here's the expectation for October. The day before the meeting, we can see we were somewhere around 70%, and now we're around somewhere like 82 for a cut. If we look at December, the third cut, again, somewhere around 68, 70%. Now we're at maybe 81 for a third cut. So we were, and this is the most important bit, it seems, on both of these, well over better than even odds, even a week ago. Never mind the day before the meeting. So another cut in October was, for the most part, already priced in. In fact, well priced in. Better than 50-50 by a long mile. And then a third cut, likewise. So if we then take a look at December, same thing. Well above 50-50 shot for a third cut even a week ago. And of course yesterday. Now, there's been more conviction in all of this, but it's not like the Fed is telling the market something they weren't already looking at. Moreover, when you consider what got you to these 3 cuts here, let's take a look at the dot plot, and you can see here is the range of outcomes calling for 2 cuts or less. Here's the range calling for 3 cuts or more. And we can see that 2 cuts or less and 3 cuts here is an even split, 9 and 9. And then we have one lone dot that apparently is so aggressively dovish that it's looking to see a much more expansive rate cut cycle, even just this year. It's calling for rates not to come down to the 3.5 to 3.75 range, but to the 2.75 to 3 range. So almost a percentage point more dovish than what the markets have in mind, certainly in what other Fed officials have on the board. And so we very, very narrowly arrive at this third cut. And part of that is the median is skewed by this very out there dot. One can only surmise that's the dot for Stephen Myron, who the president just managed to squeeze onto the FOMC before this meeting. So not exactly the most dovish signal here, since the market's already had it discounted and since the average is very clearly skewed by a single dot. The bigger story here is for next year, there's still only one cut. In June, it was from 3.9 to 3.6. Now it's from 3.6 to 3.4, but still just the one cut. And that, of course, clashes directly with what the markets have in mind. They still have 70 basis points on the board for next year. So that's at least two cuts with a strong 80-ish% chance of a third. And of course, the question continues to be, if there is this disconnect, if this is what we are looking at here, then are we going to have a situation where the stock market is going to have to turn lower in a disappointed fashion because this looks like it's more dovish than the Fed is now routinely endorsing? And do we have a bottom in the dollar here because we're not going to get more dovish on this outlook at this point, and so the dollar is basically out of reasons to fall? Looking at the comments from Fed Chair Powell here, we sort of get a sense for which direction we might be going. First, we get that there's a slowdown in economic activity. The Fed chair thinks this reflects mostly consumer spending. And of course, we've talked here on the show before extensively about the GDP numbers take on this in the first 6 months of the year. We, of course, don't have third quarter data yet, but for the first 6 months of the year, GDP numbers give us the weakest consumption in 5 years, with the reference point being the first 6 months of 2020, which of course is the COVID lockdown. That is an ominous comparison. We see that the justification for the cut here is that the balance of risks have shifted with downside risks to employment. Labor demand has softened, and job gains are running below the break-even rate. That's after that revision of annualized figures where rather than having an average clip of about 150,000 jobs added after the revisions, we looked more like half that for the preceding 12 months. And so indeed, it does look like we have a significant rethink there. Perhaps the most critical part of this equation is the Fed chair is saying, I am not blessing what the market is pricing in at all. There was no widespread support for a 50 basis point cut today. Makes sense in the context of expectations. And perhaps most importantly, you can think of this as a risk management cut. Now, what does this mean in the context of expectations? Well, if the expectations are calling for an expansive easing cycle, in particular next year, the Fed chair is very clearly saying that is not what we're endorsing. This is more like a maintenance move because the balance of risks seems to be shifting, where before we were mostly concerned about inflation and not really concerned about the labor market. Now we're a little bit more concerned about the labor market. You can see from this comment here, Fed Chair says, I don't think we can say that policy no longer warrants a restrictive policy setting. And with inflation at a 7-month high and in the vicinity of 3%, it's seemingly logical why that is. So if the story here seems to be that the market wanted something more dovish and is in fact baking in something more dovish, we can see it with the naked eye right here. And if what the Fed did with their expectations is undershoot that baseline, well, then one might reason that the path of least resistance for stocks is lower, the path of least resistance for the dollar is higher, and what we choose to think about bonds and gold probably depends on the interplay between the rates outlook and whatever risk premium is in the market around uncertainty, not the least of which around things like the Supreme Court's impending ruling, perhaps as soon as next month, about the legality of most of the Trump administration's tariffs. Lower courts have said that those tariffs, conditional on invoking national emergency grounds, are illegal. And now we're going to have to see what the Supreme Court says and whether they let the tariffs stand or they don't. But as we just spoke about on Overtime with Dylan Radigan momentarily before this show, a counter narrative and a logical one of that would be, okay, so the markets didn't get all the dovishness they wanted, hence this downswing, but they clearly recovered to be little changed into the end of the day. Ditto for gold. So is this really indicative of anything other than the market basically saying, right, this is not our ideal scenario, but ultimately this is fine? And marking resilience in the rally for gold, resilience in the rally for stocks, and we'll see what this means for the dollar, but the dollar maybe still has room to bottom. But again, this is not certainly a running away of dollar momentum, certainly not relative to this breakout out of this congestion range in the euro. One might think you would at least need to get back in here somewhere to make the case that the dollar is getting ready to run in earnest, at least from a technical or a price action kind of a perspective. So how this all filters through these markets over the next 24 hours should be very interesting indeed. And in the meantime, we are looking at a little bit more event risk overnight. The Bank of England is due to issue its policy announcement. The expectation is we're going to remain at 4% this time around. Rates are going to hold unchanged. But the really big question for the Bank of England and indeed for markets is going to be what the voting pattern here is going to look like. Because as it stands, the expectation is there's going to be fairly good conviction. 7 out of 9 policymakers on the MPC, the Monetary Policy Committee, voting for a hold, and 2 out of 9 voting for a cut. But it was really, really finely balanced in the previous decision. 4-9 for a hold, 5-9 for a cut. And that's largely around inflation in the UK looking more chipper recently. The numbers that we just got over the past 24 hours on inflation in the UK confirm expectations, 3.8% as expected and unchanged from the prior month. But that is nevertheless a repeat of what is or of what was in July at 3.8%, the highest in over a year, going back to January 2024, the last time that we were that high on UK inflation. Core inflation came down, again, as expected, from 3.8 to 3.6%, so nothing really to see there. But obviously, inflation is closer to 4 than it is to 3, and so much hotter than the Bank of England wants it. And so it'll be interesting to see how this calculus breaks out and what it ultimately means for the British pound, which held up a little bit better than the euro today. Positioning-wise, and from that perspective, I am going into this a little bit long the pound, a little bit short the euro. Still have my short put position and so long side in gold. My long calls spread in silver, so I'm still long the metals, and a little bit short in stocks. I've got a put spread in SPY, so keeping it small, keeping it risk defined, and straddling both sides of the fence. I am both long and short the dollar. I am both long the metals and short stocks. So I'm looking to see how this resolves into the end of tomorrow's session, and then I'll probably make some decisions on which side of the equation here to pick, and either the risk on or the risk off side, either the dovish or the hawkish Fed implication side, and we'll see how it goes. But as it stands, at least, the markets did not get out of the Fed everything they wanted, and the price action today speaks as much accordingly. And that's macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I am also commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading. And we are back. We have black t-shirts and glasses going on in San Francisco and in Milan. Obviously for me in San Francisco, for Mr. Radigan there in Milan. And then the face of happiness, Mr. Glenn Freiberg there in Chicago. Gentlemen, how goes it on this Fed day?
I put on my Sunday best, you know, for Jerome and the Fed. But lesson learned, never again. It's black t-shirt, and I'll throw on my.
It's funeral attire only for.
Even if
for
you just
Fed
need to
days.
wear glasses with a non-corrective lens, just as a style point, Glenn.
I've got contacts in, so I just objectively made the wrong decision today.
Okay, it's all right. I mean, listen, I make probably 50 wrong decisions an hour. So.
Thanks for having me, guys.
You only
This is
made
fun.
one wrong decision today. You're doing very, very well.
Indeed.
Well,
That's a
you know
fantastic
what
batting
made
average.
the right decision? It seems like every market priced it perfectly. What do you say?
Priced it perfectly. I mean, that was what we didn't get into that with Tom and Tony, but what I was thinking when we were talking was it actually speaks to both the Fed's good job on the Fed for sort of conditioning expectations to the point where they were on the pin there, and good job on the market sort of guiding the Fed to the pin. In the classical tasty trade world, this is about as good as it gets in terms of selling vol before the news and cleaning up after the news.
Well, let's take a look at the charts here because they are interesting. This is a chart of the S&P, and what I have here is a 30-minute chart. So one of these bars is 30 minutes, and obviously it doesn't take a genius to figure out this is where the Fed policy announcement is. But I would point out this long wick to the downside, which tells you what the markets thought of this. Now, without quibbling as to whether the markets wanted more cuts or fewer of them, I think that much is clear. I think you look at this and you go, well, it seems like the market was moderately displeased, but not in any kind of a way that mattered, at least for today. Because clearly what we have is oh, they cut. That rally doesn't hold. We then sell off aggressively and finish the day unchanged. So, in my mind, yeah, the market priced this well-ish, but clearly this wick would tell you that, at least in its initial reaction, the market didn't like it, or in essence wanted more dovishness than it got. If you consider the response from the dollar and from bonds and from gold, you also get some interesting dynamics here. So gold, similar story. It initially didn't like it because ostensibly it thought that this was less dovish than it wanted, but ultimately didn't go anywhere. While we're on the metals, let's take a look at silver here. More convincing of a disappointment, but it's silver. It's jumpy. Let's look at something that isn't jumpy, usually the euro, and for that matter, what that means for the dollar. And you find that, again, initially, oh, good, rate cut, but then the dollar ends the day stronger. And you see that across sort of versions of the dollar. Here's the pound. It ultimately looks unchanged, but that's after it erased all of a very significant intraday rally. Here's the yen. It is down, having erased an attempt to extend higher. Here's the Canadian dollar, where we also had a rate cut today. It's a little bit more convincing, but of course, they also cut rates, and theirs was also expected. So it does seem, to me anyway, that the initial kind of response from markets was, this is not what we wanted to see, but we're not sure if it's anything we need to worry about. And so we'll see now where the dust settles. But ostensibly, the readout from the markets is, we wanted this more dovish than it turned out. Thoughts?
You're saying that because of the absence of, you're saying the absence of a rally is the evidence of that opinion?
No, I'm saying it's not just an absence of a rally. There was a sell-off. That sell-off just didn't hold. But the response, I mean, here's NASDAQ. What did it do on the news? It went down here.
Mm-hmm.
Now, by the close,
the dippers are there within an hour. I mean, it lasts nothing.
It will, exactly. And so we end up unchanged. And so now we find out what all of this means with a day of digestion. I mean, this is the policy announcement. The response is negative. We then come back and ultimately end basically where we started. So, on net, is this a market that's happy with the outcome? I think very clearly no. The question is it unhappy? And I don't think we know that yet.
Yeah, I think equities are harder to read from this in terms of sentiment, but what did surprise me is how unchanged or like the dollar is, and gold as well, because we had the run up to a lot of key levels. I was looking at spot markets, but looking at, the euro hit 119, Australian dollar hit 67 cents. We saw a lot of ambition running up, and then when that was erased, and the kind of outcome was, okay, dollar a little stronger, it did surprise me that we didn't then drift even stronger in the dollar's favor and in against gold as well, just because of the week we've had so far. Monday and Tuesday, kind of the run up into this announcement, felt like more of that dovishness was baked in, priced in, that it surprised me that we didn't even settle, as low as we started the week in the euro and gold. So
this is a very, very good point. I mean, take a look at what gold did here, in case you were wondering whether the market thought that this outcome was in line or not. I mean, it's not rocket science here. We saw gold rallying into the news. The news came. We see these large wicks here where the markets thought about the news, it went this way and that way, and then it resolved, and gold went down.
But what sentiment does gold represent at this point? I mean, I don't even know.
I think gold represents anti-fiat and anti-interest rate sentiment usually. And so if
you're saying the gold weakness means not as many rate cuts as soon as we would hope on the margins, and slightly stronger dollar.
Yes.
I mean, this couldn't be, we're shaving truffles.
Well, and again, when you look at where things actually closed, you don't have conviction. What you have is zooming in on what this is, which is a 15-minute chart, and going, here's the market's reaction. They reacted in a way where they got something less dovish than they wanted, but they're not prepared to lose any sleep over it today. And the question is, does this calculus change tomorrow? While we're here, let's take a look at the actual forecasts and what the Fed actually said, because I think that's an important part of this equation here. And I'll put it up on the screen so that we can see. Here's the Fed's summary of economic projections, and I think the meat of what we need to focus on is right here. So take a look. What do we see for expectations? Growth expectations were revised higher, not lower. And you see it across the entire outlook here. Higher, higher, higher. The unemployment rate was revised moderately lower. Lower for 2026, lower for the year after. The inflation outlook mostly unchanged, but for next year a little bit higher, ostensibly because the pass-through of the tariffs continues. A little bit higher both for headline and core. And take a look at what happens with the rates projections, because this is fun. So we were looking for 50 basis points in cuts in June. Now we're looking for 75. And relative to this year, we still only have one cut that's priced in for next year, from 3.6 to 3.4. So the actual pathway from this year into next and into 2027 is completely unchanged. What we've changed a little bit is how many rate cuts we have on the menu for this year, which, by the way, to Glenn, to your point, the market's already had that third cut mostly priced in. If we take a look at what these expectations looked like, here's October, and you can see that for October, yesterday, 69% chance of a cut, today, 82. A week ago, 68, now 82. We knew the second cut was coming in October. It's there. Here's December. Here's the third cut. A week ago, 68%. Now more certain, but we're, in any case, looking at a situation where both of these cuts at these next Fed meetings were, for the most part, already in the forecast. And so when we then look at what the Fed did here, in keeping only one rate cut for next year, this is, I think, where the disappointment comes from. Moreover, this change here, these three cuts that we now expect for this year, take a look at what the actual dot plot looks like and tell me if you can figure out where the Trump administration's nominee marked his dot. So here's Fed officials here, right? And you can see that there's 9 of these that favor a more hawkish view. There's 9 of them that favor a less hawkish view. And then here's the break. I mean, clearly,
you think that's the next
this
Fed chair?
average is more than a little skewed.
But
when one person is calling for, what, 5 cuts?
But that one person might be in charge in what, 5 months?
Well, that's not how the Fed works. And Powell answered this today, right? So the Fed chair can't make these calls solo. But it is certainly interesting that we have, sort of very clearly the introduction of a view that contrasts dramatically with the rest of the committee, and that this will now be a feature. And we'll see, Glenn, to your point, how this evolves. But the forecasts here, they're not dovish. They're not dovish at all. In fact, the Fed is saying they're going to cut only one time next year. The market thinks it's like 3. And that probably is how you end up with this kind of kind of disappointing, but not anything to run away with today kind of an outcome. That slight kind of tinge of disappointment, that feels like where it's coming from.
So the slight run-up was, or the instant reaction was, okay, this looks dovish when you sum it all into one number, but then when you start digging through it, there's so much uncertainty and dissent, perhaps, that you can't really put as much weight to the aggregate number. And Powell kind of spoke to that as well, saying that it's meeting by meeting.
Right. And I mean, that's not necessarily unusual. You've had that be a mantra for the Fed for a while here, but I think that's how you end up with gold spiking lower, with the dollar erasing its losses. I mean, here we have the euro again. I mean, obviously the euro was all the way up here, and then this thing comes out, and not only does it erase all of those gains, it actually finishes the day a little bit lower. I mean, here is, if ever you wanted to see a perfect distillation of what the market thought of this announcement, here it is. Rate cut. Wait. Hold on a minute.
You're suggesting that the weight is not as many cuts as we'd hope for in the future, or the weight is growth slowing, we're cutting rates, or some combination thereof?
It seems like not as many cuts as the markets thought was the essence of the reaction in the forecast. And also the revisions are not dovish. Growth is revised higher. Unemployment is revised lower. Inflation is revised higher. They're not big revisions, but those are the revisions.
The marginal movement is slightly more inflation and slightly less jobs.
Slightly more jobs.
Slightly more jobs.
Yeah. So this is not a revision that would tell you the Fed is in dovish extrapolation mode.
Mm-hmm.
In fact, there was one comment from Powell that I thought was particularly telling. He said, you can think of this as a risk management cut in the context of the risks the labor market having risen.
Mm-hmm.
But this is not, oh my God, the economy isn't good kind of a cut.
Man, the dollar at $1.18, huh?
Yeah.
Terrible.
Yeah. I mean, and
so I mean, it just seems like a hell of a nice time to get long the dollar, especially when you do have the possibility of the tariff Supreme Court madness next month.
You do, but that's next month, and it seems like here, just looking at the liquid futures contract here for the euro, I mean, if ever there was a spot to find a top and start to head back lower, I mean, this is like the first page of a chapter on support and resistance in your favorite economics or your favorite technical analysis textbook. I mean, oh, look, a former high. Oh, look, we tested a former high. Oh, look, we failed the test at a former high. So if ever there was a spot, this looks like a good one. I'm already short the euro for what it's worth, and I'm a little bit upside.
Using
down
FXE or using futures?
Using micro futures, so I'm outright short M6E. And you can actually see it on the screen here where I'm short. So I'm short a little bit underwater here. I got in a little bit earlier. You can see actually the dotted line here where I did. So there's been a few days here that this has gone a little bit the wrong way, but I still have the position and I don't see any reason to get out of it. By the same token, though, I'm long the pound. You can see where I did that on this break higher here. So I'm not one-sided on the dollar. We'll see what the Bank of England does overnight. I have a mind to hold this for now, but my sense is that the dollar is probably done falling.
And for the dollar and gold and a lot of these global assets, do you think all the players that wanted a initial reaction are in, or do you see some substantial moves in the Asian session, the European session tomorrow, before we get another look at it in the U.S. session?
Oh, absolutely, and I think that's a very good point. The Fed comes in relatively later in the day. I mean, we're talking about what 2 p.m. Eastern. By then, European markets are closed, and so especially the liquid ones like Frankfurt and London and Paris, and so Milan, and so you look at this and you say, okay, well, Europe hasn't done anything on this basis yet, neither has Asia. And so we're going to see what the follow through is, if any, overnight. I think certainly the U.S. markets are how they open tomorrow and what happens with the benefit of a little bit of a digestion will be, I think, an important question. Because the markets they didn't get the dovishness they wanted, but they also didn't get hawkishness in a way that's spooked them for now. So now I think basically the markets have to decide, and maybe tomorrow we'll get the first signs of what that decision is. But if the hope was that expansive Fed stimulus is going to keep the rally juiced, we don't see evidence of that here.
Yeah, I think in my mind, overnight gold's the most interesting. We'll be able to see how much. I think the Asian session is really interesting for that, right? I mean, they've been propping gold up from a demand perspective, and we'll be able to see how much of the gold market right now was betting on those lower rates quicker versus risk sentiment. I don't think we know the full picture from the equity reaction, like you said, until tomorrow. So I don't know. Do you see metals moving drastically in either direction?
Drastically, maybe not, but we'll see. The dust is still very much settling on this. Dylan, yesterday when we spoke on this show, we were talking about you're going to buy them hand over fist this morning and just avoid thinking at all costs and keep buying NASDAQ. Is that where you still are?
No. I mean, I believe we should. I'm not. I am strongly of the opinion, and will implement the opinion tomorrow, of a short NASDAQ, short gold, long dollar. I call it the Radigan triple.
I like it.
We have come to an inflection point going into the fall. I believe the price levels are absurd in the NASDAQ. I believe they're preposterous in gold. And I believe they're an outrage in the dollar. I think all three are on meaningful price extremes. And I actually am shocked at the lack of, that the implied volatility is where it is on a lot of these things. And so I just think it's actually a beautiful time to be short the NASDAQ, short gold, and long the dollar. Obviously, there's a huge amount of risk for me in that by virtue of all the thinking involved. But
it does involve thinking.
With that said, I just think price extreme rules the day. I'll put it on small, and then if it starts to work, I'll get bigger, I suppose. But
that would be the way I'd do it.
And I'm inclined to do it, with openly directional put buying, honestly, on the NASDAQ and on gold, and maybe calls on FXE calls or some such thing on the euro.
Well, I mean, if we look here, just really basically, and say, okay, let's say we come into 2,300 on the NASDAQ as like an initial sort of thought process for a pullback. If we wanted to look at what, and let's go risk defined here, what a put vertical would look like here, and let's say we'll go sort of tasty methodology adjacent, and we go, in this case, 44 days out. If we take a look at a move back, let's say, over here to like 23.5, and why there? I'm just looking at pockets where liquidity seems to be, to look at sort of some sense of getting filled. And obviously this is after hours, so it's thin. But if you look at the risk reward here, I mean, it's fantastic. I mean, we're talking 3-to-1 almost. So the vol is cheap enough that even just a simple vertical like this is going to be asymmetrically enticing. If we wanted to get smaller, we could say, for example, the micro contract for NASDAQ. And let's do this same exercise here. So from where we are just at the money, out same distance here. Again, basically a 10 times difference, but the risk reward holds and still looks incredibly attractive. And if we did it even smaller as far as capital allocation and did it in ETFs with the Qs, again, same exact exercise, and we'll go to sort of a comparable level here, let's say somewhere here, give or take. I mean, again, not quite as amazing of a risk reward, but still very,